watching India Market Open, and it's luckily Thursday. We're getting closer to the week. In midst of all this festivity, bulls are slightly disappointed. Even yesterday, such a disappointment. They couldn't defend 24,500, and that makes me worry.
Yeah, I mean, the large cap action certainly a bit of a worry. And Samina, yesterday pointed out the yields, US yields at 4.20, 4.25 now. So it's becoming very difficult to predict if there is a trend, because there doesn't seem to be a trend.
There is no trend. Or maybe the trend is downward. We're just refusing to accept it.
Maybe that.
Because we're 2 weeks away from the US presidential election outcome, so that's the big one. You've got elections in some parts of Europe as well. Japan goes into elections. So from what I understand, this year is 50 countries, small and big, who have an election verdict lined up. So all that, higher bond yields, the higher dollar, weaker gold. I'm confused with what's happening in the world, but for now it's looking a little sad.
Yeah, but this is one piece of optimism before we get to the global news
one.
flow. No, I mean, there are a few, of course, including the fact that it's festive season, but the sound bites coming in from the BRICS summit, fairly constructive. I mean, India and China and PM Modi and Xi Jinping's conversation yesterday and the messaging that PM Modi gave after that. And we're seeing some bit of these issues maybe de-escalating a little bit, which I think is very important for any geographical power, right, or any national power. So that seems to be that whiff of positivity, but hope it lasts.
Yeah, I don't know how we're not, I mean, while this is, of course, good news, we've not reacted in that sense to geopolitical rising tension.
That's true.
So I think somewhere the markets have decided that the bigger picture, which is not financial in that sense, continues to be there, but taking that with a pinch of salt. But yeah, it's going to be tough. Global markets aren't looking too happy. But you're right. The big story, of course, that we're tracking this morning, some ray of hope, some relief. We want to be friends with our neighbors, and I think that's a good starting point.
Yeah, it's a good starting point. So before we get to the global news flow and the observations from Samina, here's a soundbite which is important to our mind. Prime Minister Modi and Chinese President Xi Jinping, in their first formal bilateral meeting in 5 years, welcomed the agreement for a resolution of a tricky issue of border patrolling. Meanwhile, speaking to media, PM Modi called for peace, stability on LAC as vital, and highlighted the importance of the Indo-China relationship. Let's hear him.
आपसे मिलकर खुशी है, और जैसा आपने कहा 5 साल के बाद हमारी ये फॉर्मल मीटिंग हो रही है। हमारा मानना है कि भारत और चीन के संबंधों का महत्व केवल हमारे लोगों के लिए ही नहीं, लेकिन वैश्विक शांति, स्थिरता और प्रगति के लिए भी हमारे संबंध बहुत अहम है। एक्सेलेंसी, सीमा पार पिछले 4 वर्षों में उत्पन्न हुए मुद्दों पर बनी सहमति का हम स्वागत करते हैं। सीमा पर शांति और स्थिरता बनाए रखना हमारी प्राथमिकता रहनी चाहिए। म्यूचुअल ट्रस्ट, म्यूचुअल रिस्पेक्ट और म्यूचुअल सेंसिटिविटी हमारे संबंधों का आधार बने रहना चाहिए।
Well, that's of course a much talked about summit and the Prime Minister giving his soundbite. And of course, let's move on to the action that we are tracking globally. Now, one good thing this morning is that the implied Nifty is looking slightly better than it has over the last few days, but that's not much that we should be hoping or riding on, because it's been tough. The last couple of days this week have not been very easy for any trader, any bull, or actually any trader, because even the bears might be finding it difficult, given that the markets are in a no trade zone in so many ways. Implied Nifty is up 57 points, but let's take you through what's happened globally. And it was a tough sort of overnight day of trade. Wall Street has continued to decline, but we'll talk about that in a minute. Let's quickly do a check on Asia. Asia markets are largely lower, barring Japan, which trades flat. This is on back of a weak handover that's come in from Wall Street. South Korea's GDP data came in at 0.1 expansion versus a 0.5 contraction that was seen in the last quarter. 0.2 contraction that was seen in the last quarter. But remember, the expectation was that the South Korean economy would grow 0.5%. So it's below expectation, but it's a growth versus a contraction that was seen in the same quarter last year. Apart from that, another standout is what the yen is getting up to once again, and this is interesting. From 7th of August, the yen has been a currency that has been tracked extremely closely. What we are seeing this morning is the yen trades at a 3-month low, and also down about 6% in October. Another indication that some form of risk off trade is playing out for global equity markets. On Wall Street, US markets have declined for the third straight day in a row. The Dow has seen its biggest fall in over a month. Tesla was one stock that stood out for me. While it's a heavy earnings reporting season or week on Wall Street, Tesla actually did quite well. The stock was up 11% post-reporting earnings that actually beat street expectations. So while we've been concerned about the market share that Tesla has been losing, little impact on Indian investors, but definitely worth a mention on Tesla. Now, what's been a worry from the start of this week is what's happening to the 10-year Treasury. Now, some may attribute it to what Neel Kashkari said on Monday, where he indicated that the rates may be higher than what's anticipated towards the end of the year, largely because economic data has been improving. Now, that is it's usually the deep blue sea, and of course what we have, right? Because if you have good data, that means that the economy is good. It also means lower interest rates may not be cut as aggressively. So maybe that is what's worrying traders and equity participants. But the 10-year Treasury yields continue to spike above 4.25 now. This is the highest level it's traded at since July. You also have the US dollar index that's actually spiking up. The dollar index also, just like the 10-year Treasury, trades at its highest level since July. All of these factors have kept equity markets under pressure. The statistics are that 83% of traders do believe that there will be a rate cut by the Fed. A very small section of investors believe that there will be no rate cut next up from the Federal Reserve. What you also want to keep in mind is crude has declined 1% as inventories have risen. Gold has also eased off after hitting a record high. Now, this could be on back of a stronger dollar and stronger bond yields. Spot silver has been the outperformer, right? It's been also a little bit of a proxy to play gold. Traded at its record highs, but it's declined about 3%, also because it's risen so very sharply in the last few days. You have the US presidential election outcome that everyone's watching out for. Vice President Kamala Harris has a margin of 46% to 43% lead over ex-President Donald Trump. So that's what we have. It's difficult globally, locally as well. I don't think much is standing out. But Niraj, you want to come in on global? Are you sort of, I don't know how we're looking at this, because you had Neel Kashkari early this week talking about the fact that, things aren't looking too bad. The economy looks good, data is positive, and rates may potentially be higher in a few months than the street would have liked.
Yeah, that might be a bit of a disappointment, but I think the only thing to watch is really, one of the things to watch is the US elections. Until then, things are okay. Let's wait, let's see what the yields do, and let's see what crude does. But interesting, Samina, you pointed out at the start, right, that our market's performance. So maybe a quick recap, because we just came off from the highs, really.
And it was, I think that could be a little bit of a worry, because very clearly the pressure was on the street, but this happened towards the last hour of trade. It was another down day for the Nifty. We failed to recover after falling for the last 2 to 3 days. The Nifty declined 170 points from its intraday high of 24,600. The only good news was that broader markets outperformed. And Niraj had highlighted this, right, where commentary from a whole bunch of broader market companies was actually quite positive. The markets did choose to reward that, and hence you had the small and the mid-cap index outperforming significantly as compared to the large cap. But the lack of strength to defend lower levels is what is worrying the bulls on the street. IT was the only sector that ended positive. Stocks like Persistent and Coforge had quite the day on back of strong earnings. Bank Nifty has failed to sustain at higher levels, or relatively higher levels, sustain above 51,500. Today, of course, 51,200 becomes an important level on Bank Nifty. Bajaj Finance got rewarded, and earnings were good, but the stock went home with gains of 5%. FIs have continuously been selling, and they continue to do so yesterday as well. And in the open interest data, the highest OI on the call side was seen at 24,600. The range has moved significantly lower, and on the put side, 24,400 became significant. So the trading range today largely will be 24,400 on the downside to 24,600 on the upside. But it does seem, Niraj, that we will get a positive start, and at least today, selling could abate because implied Nifty is higher. And we've come down quite significantly from levels on Monday. And I think the broader markets did better, giving me some hope.
Yeah, I mean, I think the drift down, as Samina said, the drift down from the highs on the benchmark, which is the large caps, is definitely a tad disappointing. But it's what is positive is that the mid stock still held out in trade. The mid cap index 0.6%, the small cap index, and that's the part of the trade setup, that the small cap index holding up in trade. I think that is the key crux when it comes to the performance yesterday. I mean, briefly mentioned it day before yesterday, but quant indicators are pointing to a very strong possibility of a bounce back. Maybe not a very strong bounce back, maybe just a dead cat, and who knows? I mean, we'll know the texture of the bounce back only when it happens, right? But until then, we can only think of the possibility, and there's a very strong indicator given out by multiple factors that there could be a bounce back in the large cap spots. So that's something that you want to watch out for. And a clutch of very important numbers to watch out for in the session today as well, because we've been talking about consumption and how urban demand waning has been the key highlight of Nestle and HUL's commentary. Today we have ITC and Godrej Consumer as well coming out with those numbers, and therefore those two become very important set of numbers to watch out for. There is United Breweries coming out along with Radico Khaitan after a very flat performance from United Spirits yesterday, so you will watch out for that. ACC comes out, and amidst all the disappointments that have come in from cement, and two stocks we'll talk about later on today, which had a very disappointing quarter two. The one that I'm hoping for, or one that I'm believing could actually come out with which could have fairly decent quarters. One of them is Dixon Technologies, and the other one, Samina, Ramkrishna Forgings, after that big UBS note, when they're talking about can it do another 10x in 10 years, I think what they deliver in quarter two could be a very important number two to watch out for.
So there'll be lots of reactions once again on earnings, and that's what you want to track. Bank Nifty weekly expiries behind us. A quick check of how the WIX is doing. That should also give you a sense of what traders are thinking on the street. Up about 1% again, so we're again inching closer to 15. 15 is where there's a little bit of discomfort for the bulls. But remember, it is the festive season, and everyone hopes that we see a lot more green on the street. Luckily, we still have a week to go before Diwali hits, but for now, it's actually getting only better on implied Nifty, and that's what's keeping me excited this morning. But 24,600 becomes the upside or the resistance that the bulls will face this morning. What also was good news is how well Vari Energies has been subscribed. So there is that hope to make money, to find value, to go out and bet on the next big story on the street. Significant oversubscription, record oversubscription. Vari Energies has been subscribed 76 times is what we have. And also Deepak Builders, like I said, it's a small one, but again the numbers there in terms of oversubscription are also very, very impressive. So Deepak Builders 41 times, Vari Energies 76 times. And this brings me back to the fact that if you come in at a discount, money will come in. Hyundai, which was a great story, no discount, no euphoria. Vari Energies 100% discount, and a fantastic response in terms of what retail subscription is.
Yeah.
Right? So there is something to be happy about this morning. So you have that. I'll quickly move on to stocks. We've already talked about a few that we'll be tracking, which Niraj is, of course, watching out for on back of commentary. But you had HUL that reported numbers. Numbers were largely in line. Revenue was up 2%. EBITDA was down 0.1. Margins were down 48 bips. And net profit also came in low by 2.3%. Remember, the whole sector, which is consumption stock FMCG, from -1 to +5 has been the range of revenues that they've clocked in this quarter. So that's what you want to track. This is right in between. No surprises on most fronts. VIP Industries, very disappointing numbers. Revenues were down 0.3%. But what stood out is the fact that they've reported a loss of 2 crores versus a significant profit in the same quarter last year of 53 crores. So it'd be interesting to note what has happened. Maybe there is an exceptional item there, but the stock, of course, did go home with a gain of 5% yesterday. There was a net loss also of 33 crores versus a profit of 13 crores. Was there an exceptional item on VIP, or was it just a difficult quarter for them?
No, but it's not just one difficult quarter, Samina. I mean,
consistent.
So there are some observations that I have on VIP in particular.
Yeah, please.
Yeah? The top line growth in the quarter gone by is lower than the top line growth of the June 2022 quarter. So for the last 9 quarters, the company's virtually shown no growth, right? Per se, if you go to see. Then the bottom line, has been mixed since the March 2023 quarter. 3 of the last 5 or 6 quarters have shown a loss. So the bottom line performance has been all over the place when it comes to VIP. And because, I mean, people say don't look at the valuations on the TTM multiples or the FY24 multiples, but because the trailing 12 months have a loss, I'm forced to look at the FY24 earnings. And the stock, which is not growing, is trading at 133 times FY24 EPS. I'm saying even if the stock doubles, which is not because the last 2 quarters have been bad, even if it were to double, the stock would have been trading at 60 times or 70 times. It's a really expensive stock. I have no idea how the street is paying the multiple that it is paying to VIP.
They gave him a 5% uptick in trade yesterday.
Yesterday too.
And even operational profitability, right, that is declining, very clearly indicating that in terms of efficiency as well, they're not in a position to keep costs low. So that again, I'm guessing when we talk to the management, we'll get a better understanding of what's not working for them. There are some brokerages who believe that a near-term recovery is in sight. Is it reflecting in the numbers? No. Is it reflecting in the valuations? No. Will the stock be happy this morning? If you are a long-term investor, maybe you will reward it and look beyond this quarter. But the fact remains, in terms of what we see, those numbers are a disappointment once again. That's for VIP Industries. You also have Pidilite. Revenues were up 5%, coming in at 3,234 crores. EBITDA was up 13%. Margins have improved 23.8%. Net profits are also up 18%. So again, on the face of it, these are good set of earnings being posted. But Niraj, I believe you've got a different view on Pidilite at all, or no? You think that it's a good quarter. We'll talk to the management later on in the day. They've been consistently posting quarter-on-quarter improvement, and this quarter being no different. So good earnings from Pidilite, weak earnings from VIP. HUL largely in line with the street. I'm assuming there should be a positive reaction today only because the broader sentiment might be a day of some recovery, right? So these counters have sold off so sharply that you may see some buying coming in today.
Yeah, should be interesting to notice those stocks. Those are the first 3 on Samina's list, the top 3 on my list, the first 3 on my list. I'm going with the positives, Chalo. Let's try that. So AU Small Finance Bank, NI up 58%, is a strong number. The problem is the asset quality, and which is why I think some of the bulls on HDFC Bank and Kotak Bank stand out, because they're saying in a difficult time, asset quality management will stand out. AU has had an issue on the QOQ basis on the gross NPAs. But bottom line number, still a 42% uptick, 571 crores, estimated 496 crores, so better than estimated. Morgan Stanley's target price is rupees 780. They say that it's better placed than other private mid-sized banks. So will the street reward AU? Well, I think the numbers look good. 58% NI growth is very strong. Let's wait and watch what happens here. You will hear from the management, of course, a bit later on the show. So that's the first one on my radar. Piramal Pharma is the other one, Samina, on my radar. Revenues up 17%, which is fine. But margins expanded to 15.2 versus 13.9%. And net profit up 4.6 times at 23 crores versus 5 crores. It's slightly lower than estimated. But on all other counts, they are above estimates as well. I don't know what led to the estimates of 31 crores, but a 4.6 times net profit growth is pretty strong. So I would suspect that maybe it gets rewarded a little. And then out of the blue, Samina, Care Ratings is the third one on my radar. Total income up 42%, 129 crores. I'm guessing a lot of people are now getting rating agencies to underwrite the
and because of the amount of paper that's been coming in as well,
right?
That
too, right? Yeah. So which is why I thought you would have an insight there. And the net profit, Samina, 46.9 crores versus 21.4 crores. Very strong quarter.
Very strong quarter. But I'm surprised you didn't put out Piramal Enterprise. You had Piramal Pharma, Piramal Enterprise as well. Not far behind. The group is on a roll from the look of it. Profits up 238% at 163 versus 48. Net interest income is up 17%, and they had an exceptional gain of 77 crores versus an exceptional loss of 64 crores in the same quarter. And just because I'm getting competitive with Niraj, I've got 2 more stocks that are actually good. So I'll quickly highlight those for you before we move on. You have Thyrocare Technologies that has done well. Profits grew 29%, revenue up 20%, EBITDA up 28% at 48 crores, and margins expanded by 200 pips at 27 versus 25. And Dr. Lal Path Labs, profits have grown, revenue is up, EBITDA has jumped, margin has expanded, and there's been an interim dividend of 6 rupees. So Dr. Lal great, Thyrocare good, and Piramal Enterprise is also not too bad. And there's an order win with KEC International, so there could be some reaction to that. So I mean, they usually react to these orders, right? And only because today seems to be a better morning than the last few days, we will quickly tell you what that order is, but you can go on with the other ones before I get the value of the order.
Okay, so since I highlighted 3 positives, now I'm highlighting the 3 negatives.
Good, I'm not competing on that.
The 3 results that have disappointed. Birla Soft is the first one. Revenues were up 3% at 1368 crores, in line with estimates, but EBIT margins down 265 basis points at 10.45%. The estimates were 12.7%. And net profit down 14.66% quarter on quarter at 128 crores. The estimates were 146 crores. So this one could have a negative reaction today. Remember, yesterday everything went up because of Persistent and Coforge. Birla Soft could come down today. And then Sagar Cements and Nuvoco Vistas, very disappointing. Sagar Cements, the margins are a howler. I know cement is anticipated to do badly, but these are very weak numbers. Net loss at 56 crores versus a loss of 10.85 crores may get punished. Nuvoco Vistas, revenues up down 11%, Margins at 9.6 versus 12.8. Net loss of 85 versus a profit for 1.53. So again, a stock that could react negatively. And Samina, Zomato, that platform fee increase in select cities for the festive season, where it could spur profitability. I don't know if the street rewards Zomato today.
Talking about Zomato, quick mention on Swiggy. They've also hiked platform fees. I know they're going to be listing soon. They filed their DRHP, and there's been so much of excitement around this one too. So just worth mentioning that just ahead of festive season, they've gone ahead and done the same. Niraj, I don't know whether you've tracked. Okay, just quickly on KEC, they've bagged an order for 1,142 crores. So it's a big order win. We will connect with the management to understand whether it's a recurring order, it's a one-off order, and the timeline of this order as well. But I don't know whether you tracked the news on Sona and Escorts Kubota. They've entered into a business transfer agreement with Sona BLW for transferring the existing railway equipment business division as a going concern on a slump sale basis of 1,600 crores. I don't know how much of this was in the news or in the market, and neither do I know whether the stock is going to react to this. But I believe we've got Puneet just on that. Puneet, one of the stocks to watch out for will be Sona BLW this morning. The company has released its results where it's announced that it will be acquiring Escorts Kubata's railway business. And it comes in at a slump sale value of 1,600 crores. One, what are you making of that valuation? And second, was this in the market? Is this known information? And who is this good for?
Well, it's definitely a big thumbs up for Sona BLW. I also want to just talk about the results to start with. The results were good, above estimates. So 17% revenue growth for the company. EBITDA grew also by about 14.5%. Margins coming in at 27.6% in this particular quarter, so really strong. Profits also up 15.7%, and as you rightly said, this is a big acquisition coming in of the railway division of Escorts Kubota. Now, there were certain media reports of this, and that's also because the company raised roughly 2,400 odd crores via QIP in this particular quarter, and they had mentioned that they're looking to acquire, newer technologies as well as newer divisions for the future growth. And the company is a very cash-generating company, so this big QIP did indicate that this will be for inorganic acquisitions. The pack to acquire railway division is key. As you rightly said, 1,600 crores is the enterprise value of this particular business. Now, Escorts railway business is a key supplier of suspension brakes, specifically to the railway business, and that's one of the key things. In the last fiscal year of FY24, this division did about 950 odd crores of revenue with EBIT margins of about 18.9%. So really strong EBIT margins for the company, and will match the Sona's EBITDA margins of about 27.9. It might not be as high, but definitely really strong margins for the company. The proposed acquisitions, as Sona has stated, will be EPS accretive from the first year itself. That's a positive. Now, we mentioned about the QIP, and that will be used for as well as the internal accruals for funding this acquisition, as the company has said. Apart from that, one key thing that the company also did was, roughly 36% of its revenues now come from the battery electric vehicle space, and it has an order book of about 23,300 odd crores, which is 7 times Sona's, FY24 revenues as well. And, currently they are also running multiple EV programs. But just, on this acquisition, I just wanted to highlight, what is the benefit for, Escorts Kubota to sell such a profitable business as well. Now, Kubota acquired a majority stake in Escorts back in 2021. 2021. Now they have 53.3% stake. And railway division is a non-core business for the company versus the traditional farm equipment business that, Kubota does. And for the Japanese firm, we know that, they are very centric on the traditional business that they do. So it's a non-core business and just contributes roughly low single-digit revenue on a global level. For the India level, the railway division did 10% of the total revenue. So that might be one of the rationales for someone like, Kubota to sell this business. And why is this profitable for Sona is one of the key things, because the Escorts railway division is one of the legacy business and it's a market leader in a segment. So it's a 3-player market. The other 2 are foreign firms. One is a European company, one is an American one. And Sona, the railway division of Escorts is number 1 in this particular segment of the railway space. Started back in 1961. And one of the oldest legacy businesses. Now, the acquisition fits with the company's growth strategy, as they, last year they changed the vision statement to move towards a mobility solution company rather than stating to be an auto company only. So that's one of the changes that they've done in last year, and they're moving and going into CVs as well. Now the CV division also contributes 10%. And one interesting thing is that this railway division contributes roughly 30%, is around 30% of the total revenues for Sona. So the next 2 years will see this strong bump up as the EV programs come in. So it's a big thumbs up for Sona on this acquisition. For Escorts also, it's a lot of cash that they generate in this particular year, while the traditional business has been slowing because of lower volumes. But overall, big thumbs up for both these companies.
Big thumbs up. Escort Kubota should also react positively. Sona BLW has got a good deal. It's a slump sale value of 1,600 crores. So good news for both companies. The business transfer agreement has finally been signed. So watch out for how both those counters react and trade. Well, let's move on and talk to you about what's happening in the FMCG and consumption space. Like I said, across the industry, either you've had negative 1% on revenue, or you've had a positive 5%, but none of the companies have beaten that on either fronts. HUL reported numbers. It was a mixed performance. While they were down, the stock itself is down about 13% in the last 1 month, but up 17% in the last 6 months, reflecting very strong upward momentum. Now, the company reported numbers which some may argue that one can look at as a glass half full. But Mahima is standing by to talk to us about the key trends in the sector so far. Mahima, we've had a bunch of FMCG companies report earnings, but I don't know how fair it is to make direct comparisons, because the portfolio offering of each company is very different from the other, right? And so are the growth drivers and levers. But tell me what you have and tell us who's standing out for you, who's disappointed, where is the bias?
Right, Samina, so 3 major companies have come out with its Q2 earnings, that is HUL, Nestle and Tata Consumer. And though these companies have different portfolios, there are 3 distinctive parallels that I've drawn from what the management has commented and what the trends have been so far from these FMCG companies. Now, first of all, demand has been under pressure for the urban areas. Secondly, raw material prices are inching up, and thirdly, management has taken price hikes, and they've also said that they may take price hikes going forward if raw material prices remain elevated. Now, in terms of demand pressure, FMCG companies are facing demand pressure in the urban areas, as I rightly mentioned. Rural recovery continues to outpace urban demand is one of the trends that is common amongst these companies, and demand is also being impacted due to extended monsoons for all of these staple companies. In terms of raw material prices inching up, well, prices have gone up, and this is on the back of certain raw material prices like salt. Salt prices have significantly increased. Tea costs have been elevated by around 20 to 25%. For Nestle, commodity prices like cocoa and milk have gone up, and even coffee has gone up for all of these 3 companies. So raw material prices are going up, which is kind of causing pressure on the margins overall. Thirdly, price hikes have been announced by the company so far in Q2 to combat these high raw material prices, and management in their commentary for all of these 3 companies have said that they might consider further price hikes if raw material prices remain elevated. In terms of HUL, gross margins for the quarter contracted by 140 basis points. So they expect margins to remain in the same range is what the management has said, and the company might take a low single-digit price growth, and the underlying volume growth for the company was around 3%. In terms of Tata Consumer, volumes declined by 4% due to weak demand. They expect overall margins to remain in the same range, stay flat, and might see slight improvement overall in FY25 is what the management has said. And lastly, Nestle, the cost of raw material has gone up by 6%, which has impacted their margins. Their EBITDA margins have come down to 22.9% versus that of 24.3%. So this is the overall view of what has happened so far in the 3 major FMCG companies that have come out with their results.
Thank you for that, Mahima. And of course, that's a quick review coming on HUL and what stood out in terms of the commentary. I did catch up with Sunil D'Souza of Tata Consumers yesterday and tried to understand what's really happening. Remember, they've seen a growth on revenue, but their volumes are down significantly for the quarter. Rural is recovering, but urban is struggling. So lots and lots of moving parts for Tata Consumers as well. But they do believe that the next quarter, while they couldn't guide for what they're expecting, they do expect things to get better from here on. Listen into what Sunil D'Souza had to say.
If I may term it, we are a stable, steady staples company. And therefore, while we will see some ups and downs, we will not see such huge seasonality. That's point number one. Point number two is, I think I have said it, we have seen improvement in rural. Because I think we've had more than decent monsoon. B, the MSPs have gone up a bit. And C, I think cost of inputs for agriculture, which had put pressure on real incomes in rural last year, I think those have been fairly stable. So therefore, farmer incomes are expanding and not getting squeezed. And therefore, I think you're seeing that translate into spending. But on the flip side, I think food inflation is probably pressurizing. I think food inflation, a little bit of weather and floods, etc. I think that is the second piece, which is pressurizing urban. Between the two, I think I would err on the point of probably saying we are going to see volume growth coming back in the second half of the year.
The rural markets have been on the recovery path for some time and continue to recover gradually. And please note that it's about a third of our business comes from rural areas and 2/3 comes from urban areas. In the recent near term, we have seen a certain slowdown in the urban markets. They are continuing to grow, but the growth rate is trending down. And on the whole, therefore, the markets are slightly down compared to where they were, say, a few quarters back. Now, it's a near-term phenomenon, and it could be driven by various macro factors that could be short-term or long-term in nature. And where we come from, basically, is that we have to be very, very focused to go where the growth is. We have to be very, very focused on investing behind our brands and competitive capabilities, and also really keep consistent with the market development. And finally, we have to be very competitive, increase our competitiveness, and get stronger in every market condition.
Well, it'll be interesting to see this whole divide of urban versus rural changing. And I think in conversations with managements, we'll do that, as Samina did with Tata Consumer. We'll talk to Pidilite today and try and get the same, as well as with Godrej Consumer. Is there clearly a shift happening? And therefore, even if the street does not reward FMCG, will it punish urban consumption? I think that's the big question. Something that we'll pose to our experts as well during the course of the day today. But it's time to focus on the derivative trade, and Agam is standing by to break down what the Qs are suggesting and what could be some of the money-making option strategies. Agam, good morning.
Good morning, Niraj. Well, it's been a tough market. We do know about it. While the benchmark doesn't exactly reflect that, there's been a lot of pain in the broader markets. It's been a kind of a trend over the past few days. Let's take a look at how things have been faring. Now, I'll start off with the benchmarks as usual. And yesterday, while we did see an advance earlier on in the session, that advance was sold into, and the Nifty eventually closed the day with marginal red. And we saw very little traction when it comes to open interest in its futures. The Bank Nifty futures also seeing unwinding. A lot of your traders are not only not adding to positions, but they're also taking the pedal off, or rather putting the foot off the pedal just a tad bit, even as this particular index also comes off by a certain extent. Like, moving on, we have the options expiry today, the weekly options expiry. 25,000, it does seem like it's completely out of the picture right now. We are looking at more and more writing around 24,700, 24,800 calls. And on the lower end, it does seem like 24,000, 24,100, 200 puts are where we're seeing a little bit more writing as far as puts go. But, in terms of the markets yesterday, the broader markets, the market breadth was a little bit more favorable towards advances as compared to the day before. We had more gainers yesterday. UBL, Coromandel, and Emphasis looking at an up move with fresh longs coming in. BHEL and M&M, on the other hand, looking at shorts. And among stocks which saw unwinding, we had about a short covering for Canfin Homes, Granules, as well as something like a Bajaj Finance as well. But we're looking at markets which have come off quite a bit. At least the benchmarks have come off quite a bit from their life highs. The question really is, what do you do in these circumstances? Well, let's get an expert opinion here. We have Rahul Ghosh of Hedge.in, who joins us now to give us his views on the markets. Rahul, good morning. Thank you so much for joining in. What's the approach now? It's certainly becoming a lot harder to discern trends when it comes to benchmarks. How are you reading into this?
Good morning and thank you for having me. So firstly, it's very important to understand that until Nifty crosses 25,250, which is almost 750 points away from current market price, and Bank Nifty crosses 52,500, which is another 1,200 points from here, there is no going long on the index. Even a 300-400 point bounce might seem like, okay, the situation has changed, the bottom is made, and can tempt people to go long. But it's very important to follow these levels. I repeat, 25,250 on the Nifty and 52,500 on Bank Nifty. Every rally we feel can get sold into, unless, of course, there is a knee-jerk reaction beyond these levels because of the US election outcome. And people should trade cautiously, specifically on the long side. The last couple of weeks, that's why we've been suggesting more downside positions and downside spreads rather than making upside spreads. And we continue to do so even for this week.
Rahul, you know what? In fact, let's take that up, because last week you did suggest a slightly bearish Bank Nifty strategy. What are you looking to do this time?
So we continue to have a bearish strategy on Bank Nifty even this week. Once again, we have a caveat over here. Bank Nifty is currently trading at 51,250. Once Bank Nifty breaks 51,000, which is less than 0.5% from current market price, you will buy the 50,500 put of November end expiry. Obviously, October will not make any sense right now. I repeat, you will buy the 50,500 put of November end expiry, and you will sell the 7th November put of 50,000 in Bank Nifty. So buy 5,500, 28th November expiry, sell 50,000 of 7th November expiry. Now, two things this does. If you notice that the 7th November expiry premium is almost half of that of the 28th November premium. So in case Bank Nifty does not move in our primary direction, which is down in this case, you can get 50% of the premium by the 7th of November expiry, thereby reducing your risk drastically. Now, it's also important to understand that Bank Nifty weekly expiries will cease to exist beyond the 20th of November, if my memory serves me right. So this position has to be closed before on or before that date. A possible modification that one can do, this is in case Bank Nifty does not stay sideways or goes down, the trend in this trade is sideways or down, is sell the second weekly expiry of if let's say we're doing 6th or 7th of November for the first weekly expiry, we'll do the 13th of November, which would be the second weekly expiry. This would ensure we get some more credit and reduce the debit in the 5,500 put of 28th of November.
All right. So, well, actually, Rahul, that was my follow-up question as to how we can potentially roll over the sold leg in this particular option, but you've already addressed that. And yes, you are right. In fact, the 13th November Bank Nifty expiration will be the last weekly options expiration for the Bank Nifty, which will be available for us to trade. And as you rightly mentioned, come November 20th, of course, we will have none of those bank weekly options available to trade. But Rahul, point taken. Thank you for on that note. Thank you for joining us and taking us through that particular strategy, and of course also giving us your views on the markets. With that, it's back to you all.
Thanks, Agam, for that. It's a tough ride if you're a bull on the street, but for this morning, it does look like a good start. So we will be opening gap up. Now the hope is that doesn't get sold into towards the second half of trade. 66-point gap up is what we're working with at this stage. We're still in the thick of the earnings season. A bunch of chemical and pharma companies reported earnings. Varsha is joining us with that. Varsha, it's been a mixed bag. While Piramal Pharma stood out, there were some disappointments too here.
Well, good morning, Samina. I'll start with Piramal Pharma. So, if you see, the profit have missed estimates. Revenue was up 17%. Good uptake in EBITDA margin. So, margin were 15% versus 13% last year. Now, the revenue growth was led by CDMO sales, MCG sales, and their consumer sales. EBITDA margin expansion was led by lower employee expenses, lower other expenses, but this was little offset by a lower gross margin. Now, PAT grew 4x, but it did miss estimates, but it grew 4x, which was driven by higher operating profitability, higher other income, and lower effective tax rate. And depreciation and interest costs were, largely flat year on year. Then we have Navin Fluorine International, pretty much in line set of numbers, but the commentary in the con call was actually good. So, just talking about the numbers, revenue growth was led by higher R32 sales, which is a refrigerant gas used in ACs, and improved R22 realizations in their HPP business. And there was lower contribution from specialty chemical business due to the competitive pressure that we are experiencing. And there was improved contribution from the CDMO business with focus on late commercial stage molecules. And EBITDA was in line with estimates with margin at 20.7%, but company may do EBITDA margin of 25% by the end of FY25, and the margin was led by higher capacity utilization as well as the change in mix. Now, just talking about the con call highlights, the management has order visibility in specialty chemical from Q3. They are maintaining CDMO guidance of almost $100 million of revenue by FY27. The dedicated agro specialty block is expected to start in November 24. Near-term pain still points out, but recovery should be faster, as Navin Fluorine is quite a good when it comes to peers on account of very strong innovator revenue mix, premium product positioning, and the share of dedicated contracts. And CDMO and specialty chemical visibility is encouraging from second half of FY25 as per management. And lastly, we have Syngene International. Profit did beat estimate. The numbers were muted. This was expected by the management. Revenue degrowth was led by weak US biotech funding. EBITDA margin contracted due to higher employee costs. PAT was down due to lower operating performance and income, but there was recovery seen in discovery services driven by biopharma collaboration. The new biologic manufacturing capacity is coming online in H2 FY25. They're expecting strong Q3 FY25 as per management, and they're expecting high single-digit to low double-digit growth for FY25.
Thank you, Varsha, for that. That's a good bunch and a good sort of review of what happened in the sector, in pharma and chemicals, a whole bunch of earnings that were reported. But to add to your watch list, there are going to be lots of stocks to track. Remember, the action is stock specific as opposed to benchmark related. That's the list in front of you. You've got Aster DM. Watch out for this one. It's been a good set of earnings for them. EBITDA margin is also improved. Sona BLW, one, their quarter reporting was good. Second, they're buying Escorts railway business at a slump price of 1,600 crores. TVS Motors missed street expectations. Unfortunately, the stock will be one under pressure. Thyrocare, good earnings, margins have improved and profits have also surged.
Some which haven't had a good quarter. Howler of a quarter for IIFL Finance. Credit costs have risen. There's a Q2 loss. In SRF's case, Jefferies has downgraded the stock. City's been no different. United Spirits, very, very weak volume growth thus far. Maybe the stock reacts negatively. In HUL's case as well, volume growth look weak, a very muted performance. And cement stocks, you look at Sagar Cements, you look at Nuvoco, weak top line, margins hit, very likely the stocks will react negatively. Okay. Let's get in our guest now to try and understand what to do in a scenario like this. On the derivatives and technicals, Soni Patnaik of JM Financial Services, and on the fundamentals, Nirav Ashar of Latin Manhalal Securities. Both of you, thank you so much for joining in. Soni, special thanks for accommodating a last-minute request. We really appreciate. Good morning to you. How are you viewing the trade? Because yesterday, while the SMIDs held out, the large caps kind of sold off on that rise. It almost seems that the market is saying that any rise I will sell, the dips not necessarily getting bought.
Hi, good morning, everyone. Thank you for having me on the show. So I think, Niraj, what we can see right now is that, there could be a small bounce back, a pullback recovery somewhere from 24,400 odd support levels. It may head towards 24,650, 24,750. That remains as a very critical resistance area, as a lot of call writers have positioned aggressively on those levels. If it's able to cross those levels, we can say that there could be some short covering. However, there is a higher possibility that the moment we test these levels, the sell on rise actionable gets triggered, and you can see the selling pressure happening from those levels. So I think it's fine to, just see the pullback, how it goes. However, the overall structure for the indices still remains as a sell on rise. We see net shorts increasing by FIs. We see a lot of cautious trades happening, and when it comes to indices, call writers are quite aggressive. So overall, it's a sell on rise. The only index that may be a savior remains Bank Nifty as of now, which is still holding above a 51,000 support level. So as long as Bank Nifty is not breaking below 51,000, there's a possibility that it can save. However, if Bank Nifty were to break the 51,000 mark, then one should brace for impact. It can head lower towards 50,400 odd levels. So I think it's very important for both the indices to hold on to the support levels, maybe see a small pullback, but more important would be for Bank Nifty not to break below 51,000. Otherwise, the overall structure would remain quite weak for both the indices, and a hedging strategy would only work as of now.
Well, hedging strategy is the only thing that's going to work right now. Nirav, how are you feeling about the markets? Have you been shopping? Discount buying, bulk buying is underway right now in the broader markets for you?
Good morning, and thank you for having me on your show. Well, it's been a shocker in the markets, and I think if one were to just sum up the performance during the last 2 quarters, in the first quarter we had all kinds of reasons like a severe heat wave, elections, and a lack of wedding dates, etc. In the second quarter we have had excessive rainfall, etc. And I think now the focus of the FIIs has been on fair and square on the valuations. Since valuations have begun to look very expensive, I think this has triggered off a selling spree in the market. And I think this is likely to accelerate in the near future. So at least we would be in no hurry to buy at this point of time, because we believe that any rise in the market will be used as an opportunity to sell. So sell on rise remains the theme at this point of time. And there is very less valuation support in the market. Most of the sectors have been under pressure. If one were to look at the early results which have been announced, I think no major fireworks over there too. So I think caution is extremely warranted at this point of time.
So in light of this, what's the trading strategy for the day today on specific stocks, Sony? Interestingly, you've chosen one stock which is going to come out with its results.
Right. So I think, both the stocks that I've chosen have seen data. So first would be in MCX. Now, MCX has seen very good, adding up long positions yesterday. It has also seen a bullish engulfing candle pattern on its daily charts. Now it is holding on to it a very strong support of above 6,600. So MCX here remains a buy in the range on 6,650 to 6,600. So one can continue to buy in that range. Keep a stop loss of 6,450. The targets over here would be for a positional play towards 6,900, 6,950. So I've given a bit of a generous stop loss and target over here, considering that it can move. It moves quite wildly. So I think that level of accumulating on dips for MCX is a good strategy to follow. The second pick is a sell in Godrej CP. Now, Godrej CP has been trading below its 200 EMA for 2 days now. It has been closing below its 1300 level, which is an option chain breakdown. So in Godrej CP, if it breaks below 1290 in futures, one can sell only then. So it becomes a conditional sell in Godrej CP. Sell below 1290, keep a stop loss of 1305 in futures, and a target of 1270, 1250 can be seen. So it's a conditional sell.
It's a conditional sell coming in on Godrej Consumers. Nirav, in earnings, what stood out for you? We had a whole host of good earnings in the sense that the management commentary was a lot more optimistic this time than we have seen in the previous few quarters. Anything that you liked, that you saw, that you would look to buy?
There were quite a few companies where the performance, the Q2 performance was quite weak, but the earnings commentary has been quite strong. So I think one company which we like particularly, Sterling and Wilson Biotech, we had a good set of numbers from the company. The order book is quite strong at this point of time. And the execution also has been quite strong. So I think we particularly focus on this company at this point of time.
Okay. Now let's talk about some of the companies on which the results have come out, or there are some news flow. Niraj, what about some of the cement companies that have come out with numbers? So Nuvoco Vistas had a weak quarter. Sagar Cements had a weak quarter. We've seen the larger ones come out with a weak quarter as well. Will these stocks get punished? Do you track any of them individually, or are you looking to buy them at lower levels?
Yeah, we've been tracking the cement sector very, very closely. There have been a lot of developments in the cement sector of late. To start off with the results season, I think the first we had results from Dalmia Bharat, weak set of numbers. Now, Dalmia Bharat prides itself in being the lowest cost producer of cement in the country, but I think the problem has been with the demand. The realizations have been on the lower side. Consequently, we've seen a dent of around 64% in the net profitability for Dalmia Bharat. Then we had Ultratech Cement, where again around 30% fall in the net profit, while the volume growth has been very negligible at around 3%. Third, yesterday we had the results from Birla Corp, and I think the Birla Corp results have also been very disappointing. There's been a sharp dent in the EBITDA. Nuvoco Vista and Sagar Cement have also been a disappointment. So overall, I think the realizations as far as the cement sector have been under tremendous pressure. And I think it's on account of the fact that this has been monsoon, so the demand tends to be on the lower side. But going forward, there is an expectation that demand will pick up. But I think the broader context is that who will achieve the cost leadership in the cement sector. The fight is going to be for the cost leadership. So I think Ambuja acquiring Orient Cement, that has also been the news in the news. But the market has given a thumbs down to all these activities at this point of time. So I think overall the outlook for the cement sector looks weak, at least in the near past. But hopefully, if they are able to get their act right on the realization front, on the EBITDA front, then things could improve.
The other stock that I really want to talk about is VIP. Because, just for the benefit of viewers who are tuning in right now, Samina highlighted this stock on open. The fact that the numbers have looked the way they have leaves a bit to be desired, and one wonders, while it's a difficult stock to trade, what could happen to it in terms of punishment based on just this quarter.
And the fact that it ran up, actually no, it was up.
But now 1 month it's down.
But 1 month it's down, but up 5.5% yesterday, which makes me wonder what the street was anticipating. But Sony, you want to come in on this one? Technically, how is VIP placed?
Samina, VIP has seen a recovery yesterday. It's the first candle that has shown the signs of a reversal on daily chart. So I think 470, 475, that range has held on to a good support. A sort of a bullish engulfing candle pattern can be seen on daily charts. Now, if it's able to sustain above 515 today, then there's a possibility it can head higher towards 535, 540 odd levels. So I think that's the levels to look out for. There could be these levels could get tested, and if it's able to sustain even above these levels, a positional target towards 565 gets open.
Okay. Now, the point about VIP, Nirav, what do you do here? The top line growth, for a top line number for the quarter gone by is lower than the June 22 quarter. Bottom line is patchy. Valuations are expensive. Why should somebody own this stock?
Actually, this market is an oligopolistic market. So basically, there are just a few players which are there in the listed space also. And I think that could be one of the reasons for the premium valuations, VIP and Safari Industries. And I think based on the commentary which has come from them, hard luggage is a segment where they've been doing quite well. But overall, I think when we see the numbers optically, they have been very, very disappointing. I think it could have something to do with their presence in Bangladesh also. So I think some commentary is awaited on some disruption in operations in Bangladesh could have hit the financial performance. But I think, of course, the financial performance yesterday leaves a lot to be desired, and we are likely to see some price correction in the stock on account of this.
And actually, Niraj, why don't you come in on this one? You did say that it's a limited place. It's a duopoly of sorts, right? You've got VIP on one hand, you've got Safari on the other. Has Safari stolen market share from VIP? Because over the last 3 years, VIP has been gradually giving up market share, while Safari has been gaining market share. Between the two, while you're not constructive on VIP, would you still buy Safari? Because Indians are traveling more, right? And the one way to play that wave is to buy suitcase companies or luggage companies.
Well, that's true. The demand has been on the uptrend, and the realizations, the ticket value overall has been going up. There's been a sharp rise over there. And of course, it's an aspirational purchase also. So I think both these companies have benefited, but I think, of course, as you rightly pointed out, Safari industry is likely to steal the show as far as valuations are concerned, especially after this Q2 performance which has come in from VIP industries.
Yeah, well, and just a small deep dive out here. Samina was prompting me about to look at it. Safari June 2021 revenues were 120 crores. June 2024 revenues are 450 crores. So they've actually gained revenue, they've multiplied revenue 3x in 4 years. So they've actually done really well. And even from the June 22 quarter, which was 300 crores to 450 crores in 2 years, that's about 150 crores added to a 300 crore base, which is not bad at all. So actually it's been a rank outperformer on the revenue front relative to some of these other stocks.
And just to add to that, the other reason it's actually working really well for Safari is they've seen 25 to 30% of their revenues come in from online sales compared to VIP, which is sub 15%. So of course, the stronger online presence in today's day and age is the other factor that's working for Safari. And the other thing is that their product diversification is so large, and they of course keep coming up with better priced products such as backpacks and laptop bags, which is again a segment that's grown significantly well for Safari. Let's look at how it's done in the last 1 month. You did see that VIP is down 12.5%. Safari in the last 1 month is actually 5% down, but not as bad as VIP. It's a outperformer of some sorts. But let's go back to Sony. Sony, a quick check on what you would be doing with some of these large cap consumption names. I'm going to throw in HUL, Tata Consumers, and also add Nestle and ITC to that, because these stocks have had it rough before the earnings. Earnings have promising that from the second half will get better. So fundamentally, maybe some positive. But in terms of stocks, would you buy any of them this morning?
So, Samina, I think, the entire space has been sort of an underperformer this entire series. If we talk about HUL specifically, it's just right at the cusp of its 200 EMA. Now, technically speaking, 2600, 2610 is a support one can watch out for. The 200 EMA is placed over there. Plus, the put writers base is also around 2600. So just out of the entire large space, then maybe HUL is a good buy from current levels. The support is very much closer. So any small decline towards 2630, 2620 range could be the range one can accumulate and reinitiate longs. The stock can bounce from those levels anywhere towards 2730 to 2750. It becomes a positional play, maybe not an intraday play, but buy and dip strategy for HUL certainly looks like a better strategy.
Take a break. Stay on, both of you. We need to slip into a quick break. Back with the pre-open session.
Well, I'm not want to believe what I'm seeing on the screen, so we'll let it be for now. The pre-open all over the place. But Sony, let's go back to talking stocks, right? What are you doing with IT stocks, specifically mid-cap IT? Yesterday on back of Persistent, the whole sector did quite well. So Persistent, Coforge were good gainers in trade. Today, as we set ourselves up this morning, any of those IT counters become good buys, you think? Long trades there?
Depends. I think if Coforge is able to sustain above 76.20, 76.30 levels, and we can see a good move above those levels. So I think Coforge would be the first stock to watch out for. If it comes to Persistent, maybe around 52.20, 52.30 levels, if it's able to hold on to those levels cross, then that also becomes a good buy. So there's a possibility for both these stocks to continue outperforming. It's not a buy on dip strategy, but they have to cross the resistance, and only above the resistance it becomes a buy. So any dip that we may see in pre-open or in the morning's time, it's better to avoid the dip and let them cross the resistances. Then only I think it becomes a good buy.
So it's not a buy the dip, but it's actually is if the resistance has been taken out, then these stocks become good buys. Nirav, your thoughts on IT? You saw what Persistent delivered, and they seemed pretty optimistic. Steady as she goes is what they maintained in terms of the second half of the year. Do you feel like some of these names like Persistent, Coforge are good stocks to add to your portfolio at current prices?
Well, yesterday we did see some good commentary and some good results coming in from the mid-cap IT stocks, particularly Coforge and Persistent. We saw some good momentum in First Source. We saw Memphasys and Zensar Technologies to surge in trade. But looking from a valuation perspective, I think still we would like to avoid these stocks and focus on the large caps. And I think there we would like to focus on TCS and Tech Mahindra. Tech Mahindra is looking attractive from a long-term perspective. So I think our focus would be still be on the large caps.
Will be on the large caps. That's where the focus will remain. Bajaj Finance, how did that look? Sony, 5% higher yesterday. Do you feel like the rally could extend? Has it taken out significant resistance levels and hence looks good?
So yesterday at the bout of short covering, it did see a good recovery. However, these resistance around 7,200, 7,150, that range is still quite intact. Not just in option chain, but also on technical charts where 200 EMA is placed. So only a move above those resistance levels of 7,200, the stock can reclaim its previous, resistances of 7,500 odd levels. I think that's the level to watch out for. But anyway, at current level, 6,800 acts as a good support. So if it's able to hold on to the support, gradually it may test to break above the 7,200. So I think one can accumulate at the current levels, but only with a strict stop loss of 6,800.
Nirav, are you buying into banks? We've seen a couple of those earnings. Some have been quite impressive. And the stocks in some way have reflected that in the last few days. Any banks that you like? And also, if you want to just let me know or give me a sense of specifically the HDFCs and ICICIs of the world.
Yeah, exactly. I wanted to discuss that only. I think HDFC Bank and ICICI Bank remain our prime picks. And I think at this point of time also the kind of moves which HDFC Bank is showing, I think definitely warrants a buy from a short-term to a medium-term perspective. And I think the same almost holds true even for ICICI Bank. So I think these two would be our preferred picks, and to a certain extent even State Bank of India.
That is the word coming in. Banks today looking slightly quiet as we see it. Well, it's 9:05 and as always it's time for our brokerage calls. In fact, we have two very important notes today. Harsh is joining us with more on that. Harsh, what's on your list this morning?
Well, 19% upside both on Paytm as well as PV Fintech, so platform companies, and Citi has come out with one. They've upgraded Paytm in terms of target price from 440 to 900 and offering a 19% upside. And second, they've opened a positive 30-day catalyst watch on PB Fintech. So both of those good opportunities. I'll come to Paytm first. One, approval from NPCI is a key headwind which has now gone away. According to Citi, regulatory headwinds now ebbing, which is a key positive. They believe monthly transacting users should only improve from here on. There's a huge reduction in OPEX, which they look at constructively in Q2. They believe that that will impact numbers going forward as well. And they're raising their target multiple from 30 times EV/EBITDA to 42 times. And that's what's really led to that hike in target price from 440 to 900. I'll switch focus to PB Fintech. They believe that three catalysts could ideally drive numbers. They believe sustained momentum in retail, health and protection, higher cost absorption and lower new business strain will lead to better numbers, and lower business related investments, along with some clarity with regard to how the new business investments are going to pan out with regard to their new venture, which is likely going to be in hospitals, and how that's going to play out. A lot of clarity on all of that could likely drive a 19% upside on the stock in the next 90 days as per Citi.
So those are the few stocks you want to track. PB Fintech trading flat in pre-open trade, but the support will be one that you want to see in terms of a reaction. A couple of mid-cap earnings that reported earnings, and I just quickly want to take you through it, and then we'll get a view from Chandan, Sony and Nirav as well. You had AU Small Finance Bank, strong earnings. Let's see, the stock is reacting in pre-open trade, about 1.5% higher. Fed Bank Financial Services, profits were good. Karnataka Bank was the other one. MAS Financial Services, some of the other ones, Fed Bank are 4%, so we'll get a view on that counter. Piramal Pharma, Piramal Enterprise, both reported earnings that were very good in terms of beating street expectations, but the stock itself is not doing too much as we see it. Piramal Pharma are 4.5%. Pidilite reported numbers, good set of earnings there too. Sona BLW was the other one to watch out for, and Escorts Kubata. So those are a few other counters that the street will be tracking quite closely today. Nirav, what have you made of Sona BLW's earnings and the fact they've bought out the railway vertical from Escorts at a slump value of 1,600 crores? Do you think is it a good strategic move coming in for Sona BLW? And of course, their earnings also are fairly impressive.
Yes, Sona BLW has been doing quite well. I think their presence, predominant presence is in the battery electric vehicle space. They've been deriving around 80% of their revenues from this space. They have a very strong order book to the tune of around 23,800 crores. And I think this is a very big positive. It's around 6.5 times their FY24 revenues. So I think from that perspective, the revenue visibility is quite strong. So I think when we look at the numbers, the revenue growth, the growth in EBITDA leaves a little bit more to be desired on the revenue growth front. But nonetheless, the results have been good. But it's there in the valuations. It's captured in the valuations. So that is one part. And as far as the Escorts Kubota thing which you pointed out, I think it was already decided by Kubota. They have taken a decision that they want to focus on the tractor business. They want to make India as a sourcing base for various countries, because they want to compete very aggressively with the Korean players as well as the Chinese players. And their focus will be on construction equipment. Regarding the railways business, they are of the view that they can add very little value to this business. So this decision has been taken earlier to dispose of the business, and I think this has been acquired by Sona BLW. So I think it would be a business which they would look to scale up from the current levels. So it's definitely a positive for Sona BLW, but I think as far as valuations goes, it's already there in the price.
Right, that's Sona BLW for you, and Escorts Kubata as well. Sony, what about you? What is your thoughts on both these counters?
So, Samina, I think if you look at Sonata, then on charts, it's looking sort of, in a sideways trend. If it's able to sustain above 672, which is the emerging immediate resistance, I think above that, one can see it heading higher towards 685, 688 on intraday basis, and a positional basis even test 700 plus levels. Immediate support from the current level 655 is very important. If it's holding on to that level, then possibly it can see higher and head towards the other resistances towards 700 level.
Right, that's Sona BLW for you. The stock is expected to see a good gap up, and that's reflecting in the counter. Well, apart from that, a few more stocks that, Sony, you can come in on is banks. Would you trade any of the banks today? Because the hope is that Bank Nifty may just support the Nifty in trade today. And if it does, where do you think the bias will come from? Is it going to be private sector banks? So maybe a trading pop, right? Intraday, a quick in and out on any of the banking majors?
I think, Samina, if that support it surely should be from the heavyweight private banks, which is HDFC Bank. Now, there are two reasons. HDFC Bank continues to hold above a 17-15 level. So that's an option chain breakout, which we consider, in derivatives data, and it's continuing to sustain above those levels. So there's a possibility that HDFC Bank may head higher towards 1760. ICICI Bank, right now, we're seeing a bit of a sideways trend. So maybe in ICICI Bank, it takes the support from lower levels of 1240 and then sees a bounce. But on immediate basis, I think it's HDFC Bank that could lead the entire index and give that support to Bank Nifty.
Right, that's the word coming in some of those private sector banks that we've been tracking in trade. Across the broader market universe, there'll be some more stocks that will react to earnings and positive news flow. I want to pull up KEC. Let's see if it's doing anything this morning. They've bagged a pretty big order. You'd imagine that the stock should react positively to that small reaction. It's up about 1.5% is what we have. You also have, if I can just have a quick check on how some of these other earnings are doing. VIP Industries, we talked about that already, but a quick take on how the stock is doing in pre-open trade. The numbers were disappointing, giving up pretty much all its gains from trade yesterday. Thyrocare Technologies, good numbers, and Dr. Lal Path Labs, also the numbers were pretty good. Thyrocare and Dr. Lal Path Labs, any preferences here, Nirav?
I think both of them look fairly valued at this point of time.
What about you? Right. Nirav, please. Nirav, I think I lost you. You want to just repeat your answer for our viewers?
Both of them are fairly valued, so I think wouldn't comment much more on that.
Okay. Sony, you have a trading call on either of them?
I think Lalpath Labs, a bit below its resistance, below its support levels. So if it's able to sustain above 33.25, 33.30 levels, the covering can be seen, and that will be a very good short covering one can see in the stock. Heading higher towards 34.20, 34.50 levels. I think that's a level to watch out for. It seems to be opening a bit in a gap up. However, it needs to sustain and then cross the, immediate resistance of 33.25.
Sony, we have about 2 minutes to go for market open. Your top trade, anything that you've spotted in pre-open trade? Because the moves are wild on the downside and not so great on the upside, even on good earnings.
I think AU Bank, one can just watch for that stock. It has seen the first reversal candle yesterday, and if it's able to sustain around 660, 665 levels, the stock can move higher towards 600, 90 to 700 odd range. I think that's the level to watch out for. It's very near to the support of 650, which is very good support. So I think the risk reward ratio also gets quite favorable. So one can look for AU Bank for intraday purpose.
Quick one. Have you been tracking Amber? Right, I think we have 1.5 minutes to go. But Nirav, very quick one. I don't know whether Niraj spoke to you about Amber Enterprise, but do you have a view on this one? Earnings have been exceptionally strong, and the outlook, commentary, all looking positive. Stock, of course, at an upper circle of 20%. Today, I don't know if there's an opportunity, but if there is one, would you be adding this to your strategic portfolio?
Well, there's a strong possibility of good follow-up buying happening in Amber Enterprises, but I think we would wait for some correction before making an entry into the stock.
Is it giving you the option, Nirav? You would buy it today or would you buy it later?
I will buy it later.
You would buy it later?
Yeah, because once you miss the rally, it becomes difficult to catch it. So I think it's better for the things to cool down before making an entry into the stock.
Before we get the profit watch list here, Sony, I'm intrigued to ask you, between AU Small Finance Bank versus the other stock that you mentioned as a buy, not the conditional sell, but the buy, which is a stronger buy?
I think AU Bank looks like a strong buy. I think that's the level watch out for. The other buy that I had mentioned in the morning was MCX, which is more of a positional buy. So AU Bank for intraday looks out better, from a trade perspective.
Okay. So AU Small Finance Bank versus MCX. AU Small Finance Bank top buy from Sony. Okay, just 13 seconds left. Maybe we can't get the watch list up, but here are some stocks that you should keep on mind when trade begins this morning. Remember, Aster, Sona, TVS, Thyrocare, and a clutch of others, which are all looking okay. Some of them at least are looking okay. But here come the first trades this Thursday morning. Flat though, absolutely flat. Banks doing okay, interestingly so. Would love to know if HDFC is piling it on or some others. Bring up the mid-cap and small-cap indices very quickly before we get to the heat map. And mid-cap 0.2% higher, small-cap 0.3% higher. Not a bad start, really. Let's get the heat map up on the screen. Let's see which bank it is. HDFC Bank it is, which is driving. Trent, Hero, HDFC Bank, Bajaj Finserv, Cipla. So there's no pattern here, all over the place, really. What I can definitely say is that HUL is the one which is pulling the pressure aside of stocks like Hindalco, which has cracked 4.5% today. Has to be an adjustment of sorts unless I'm very wrong. SBI Life down about 2.5%. IndusInd, iShares, Tata Consumer, Titan, but more green than red. But a very, very flattish kind of a performance really on the large cap space. Trent on the upside, Hindalco on the downside, HUL seeing serious pressure. Now, before Samina comes here, just want to mark maybe KPIT Tech before Samina takes over, and should get that stock up on the screen because JP Morgan says that the guidance cut would make the stock react negatively, and it is 5.5% lower for this one. So the big mover is KPIT Tech of the morning on the technology side. Samina, over to you, the broader end of the spectrum.
Lots of earnings reaction. VIP Industries, let's pull that one up and see what the stock is getting up to. Numbers were a huge disappointment. The stock should be beaten down, I would imagine. Gave up about 6.5%. So pretty much given up everything from yesterday. Maybe VIP's loss is Safari's gain. While we're at it, let's take a check of how Safari is also doing, or maybe the industry is not too excited after seeing VIP punishing Safari too, but it trades flat as we see it. Sona BLW, good set of earnings. They're going to buy the railway department from Escorts Kubata at a slump price of 1,600 crores. The stock is up 7%, looking really good as we see it this morning, and the buying is only picking up. Take a look at Escorts Kubata as well. Let's see if the market likes the fact that they've gone out and sold it. No, they don't like the price, I think. So while it's only one person who wins in a deal this time around, it's Sona BLW, the buyer of this Escorts, seeing some pressure, down about 4% as we see it. In terms of earnings, Thyrocare Technologies reported numbers, good set of earnings there. The stock should be reacting well to it. 4.5% higher on Thyrocare is what we have. Dr. Lal Path Labs as well reported numbers. Numbers were good. The stock is up 3%. Piramal Pharma, again, very, very solid numbers coming in from Piramal Pharma. It might be, there you go, 4% on Piramal Pharma. Piramal Enterprise, while we're at it on the same group, the stock reported numbers. Despite a 300% jump in revenue, the stock is actually down 3%. Birla Soft, numbers weren't so great. Profits have fallen, revenues have risen, largely in line with the industry. The stock gets a thumbs down, 6% lower is what we have. Birla Corp reported a loss versus a profit. Revenues have also declined. The stock should be one reacting to those numbers, down 2% as expected. VIP Industries we've already done. AU Small Finance Bank is one you want to track today on back of a reporting that was much better than what the street was expecting. 3% higher on AU Small Finance Bank. Profit Bank also reported numbers. Profits have risen 12%. Net interest income has seen a jump. AU now at 3%. Let's look at Fed Bank and see whether the reaction is similar to that of what we are seeing on AU Small Finance Bank. Fed Bank trading flat to slightly higher. In other earnings, Karnataka Bank, Mass Financial also reported numbers. We've also got Navin Fluorine. Numbers were a disappointment. Karnataka Bank also looking weak on reporting. 3% lower is what we have. Navin Fluorine, if we can get that one up to 4% higher on back of its earnings. Well, I think I've gone through pretty much the whole list of numbers, but IIFL Finance, remember, they've been under pressure on back of regulatory restrictions. Net interest income has dropped. They've also posted a huge loss. So 4% being cut on IIFL Finance, but KPIT, the stock of the morning, down 8% along with VIP on the downside, Sona BLW on the upside, is a good one. Amber hit upper circuit yesterday. We'll talk to the management very shortly. Let's see if there's any follow-up buying that we are seeing on the counter. Taking a break, consolidating after a very sharp up move in trade. Another one I want to quickly check on is KEC. They won a big order to the tune of 1,200 odd crores. The stock is up about 1.5%. You've also got Adani Power. The board meet is on the 20th of October. They are considering a fundraising plan, so that stock will also be one to track this morning. But and also I'd like to do this. Hyundai stock, after its listing on Monday, it's been on the sell side for the last few days. Hey, it's up today this morning, 1.5%. Marginal gains coming in on this. Hindalco, I don't know what's happening there, 5.5% cut. Metals today not giving the markets the support they need. Hindalco losing pretty badly. SBI Life down 5%. So it's a tough market, Niraj. As much as we hoped before or at 8 a.m. this morning that we defy the selling from the last few daes, it's bad. Nifty 50 is once again in negative territory, threatening 24,400 now as we see it.
Yeah, I wonder if there is a one KPIT is a classic example of a high price stock not giving the first whiff of a growth scare and the market really taking it down. I think on Hindalco's case, Constellium was down 28% overnight because the demand commentary was very weak from the EU and US auto, which is about 38% share, and specialty segment, which is 17% share. So I think there is positive commentary on packaging, but everything else is looking slightly wobbly, as a result of which Hindalco seems to be lower. Now, Niraj, sorry, Samina.
Yeah, because it's the only metal player in this sector that is being hit as hard, right? You look at the other ones, the Tata Steel, a SAIL, they're not directly comparable, but commodities as a play is not doing as badly as Hindalco in trade. I don't know what's happening with insurance companies again. So look at SBI Life, 5% low on SBI Life. I don't know what's going on there. Sony Godrej Properties care ratings, very strong numbers. It's done a good up move. Like we said, right, a lot of corporates looking to do fundraising. I guess rating agencies in the money. You've had a whole bunch of listings as well coming up. So all that is good business from there. 361 WAM is also up 3%. Skipper is up 5%. So that counter also gaining trend, gaining strength. We'll talk to the management of Syngene on back of numbers. The counter is up 4%, but the Nifty itself is struggling around 24,400. Very quickly, Sony, I think you had a sell call on Godrej Properties. Can you correct me?
Godrej Consumer.
Godrej Consumer, yeah, because I was about to say that Godrej Properties is up and about in trade this morning. You want to give me any other idea that you've thought of in the last couple of minutes? It's, like I said, on the downside, the moves are wild. On the upside, you have a Skipper, you have a Care that are looking really good, a Sona BLW. Any trading opportunities? Let's keep it simple, on the long side.
Absolutely. So, Samina, I think since you've highlighted Godrej CP, it is very much closer to the hitting target 1. I think 1271 was the low today and 1270 was the target. However, if you look at the long side, since you've highlighted, and I was just checking the charts of Godrej Properties, it is indeed looking good for intraday. It has just crossed the 20 EMA hurdle. So that's a good, level to watch out for. It's just above 30.30. So I think Godrej Properties possibility, keep a stop loss of 30.30, 30.30. Look for intraday targets of 31.20 and 31.40. I think that's a good long to go for intraday purpose.
Okay, I'm very, very interested in highlighting Hindalco yet again. Sony, a trading call here. It's down 4.5%. Because of these overnight numbers, the stock is down, but aluminum prices are actually close to all-time highs, if I'm not wrong. What do you do with the Hindalco? Forget the fundamentals, Sony. The derivative positions and the charts, what do they show?
Niraj, it's looking quite weak even on derivatives.
Okay.
And absolutely weak. I think it's heading for lower support levels of 640 odd levels. Now, there are two things to watch out for. That's the 200 EMA. There's a lot of gap left for the stock to fall and take the support of 200 EMA. It becomes a positional sell. Even on the derivative parameters, I can see that it's given a significant option chain breakdown. So I think both the negative indicators may drag the stock lower towards 630 support. Only from there we can see a bounce.
And Niraj, what do you do with a Hindalco on it's 5% lower? Metals don't have the China tailwind as well. If you had it in your portfolio, would you stay put?
I think it would be better to hold the stock.
Hold the stock. Why so?
Yes.
Why?
I think because the domestic demand continues to be quite strong, there's a strong parentage, and I think these headwinds should settle in a matter of some time. So I think it will be a hold. And if it corrects further, then definitely we would like to add on dips.
Quickly, a quick view on KPIT. Sony, are you tracking this one? It's under pressure this morning. Actually, why don't we do KPIT on the downside and CARE on the other? I don't know whether you've shared your view on CARE, but anything on KPIT, the stock's not looking good as we see it.
And I think, Samina, KPIT continues below 200 EMA. Positionally, it has turned on weeks. I think as long as it's not able to cross above 1620, the stock will remain under pressure. And anyway, towards 1440 is the next support to watch out for. So it's a positional, sort of a sell that one can see. And talking about CARE, of course, on charts also, it's looking sort of a bit weak. Not very strong. It's just right up to the resistance. Now, if it's not able to cross 1325 levels, the stock can see selling pressure from those higher levels. So, maybe the resistance is just not looking very strong right now. So I think if it's not able to cross that levels, the selling pressure may continue. So I think one can just wait and watch for the stock and hold. If it's not able to cross the resistance, book out your profits and just look for a significant dip towards 1240 to reinitiate longs.
Initiate longs out there on CARE. KPIT looks wobbly. That's the view from our guests. Sony, Nirav, thanks so much for joining in and giving us those perspectives. Really appreciate your time. Now, Amber Enterprises is a stock in focus because the company posted a really remarkable set of numbers, 81% uptick in revenues. On that base, on that business, for margins to expand 40 basis points is interesting. Net profit of 20.9 crores, the estimates for 3.5 crores. Jasbir Singh, Executive Chairman and CEO of Amber Enterprises, joins us. Mr. Singh, it's been a really long time, but good talking to you again. This is Niraj here. Good morning. Thanks for joining in. I hope all is well.
Good morning, Niraj. Thank you for having me on the show.
The pleasure is entirely ours. So put the quarter into perspective. Yes, the estimates were strong, but you've beaten estimates by a handsome margin. Did some order or execution get preponed, or is this the sign of things to come?
Well, we've been working on diversifying our portfolio, both in consumer durable, electronics and railway applications. And I think that is fructifying now, that is showing the results. So what we are looking at this quarter is the result of the hard work team has done in last 3 years. We have added some more customers. We have added some new products in all the divisions. And that's where the positive growth is coming from.
Well, okay. So please highlight what's gone behind this kind of uptick, both in Q2 as well as H1 maybe. And what does this mean, therefore, for the whole year for Amber Enterprises? And let's start with FY25, then we'll move to the longer term.
Well, I'll talk to you about the three divisions. In consumer durable, what we have done is we've added some new customers. We've also shifted some product portfolio. So we have added tower air conditioners, we've added cassette air conditioners to begin with. And also we begin the washing machine business and commercial air conditioner business. So all of them has been added, and now it is reflecting in the top line. On the electronic side, we have basically we've acquired Ascent Circuits, and in the application of PCBAs, we have graduated from consumer durables to hearable and wearable. We've added telecom, and we've also added automobile customers very recently, and smart meter customers very recently. So all this is fueling the growth in both the divisions.
So hi, it's also Samina joining in. One vertical that unfortunately has seen a degrowth is the railway segment, where revenues were down 6.3% YOY. But of course, I believe you're confident that there will be improvement, but it will only happen in FY26. You want to tell me what went wrong here and what is the growth trajectory? Will we see a big swing on the railway vertical? Because if you're firing from all cylinders, this is what you need, right?
Well, Samina, on the railway applications, we are very bullish. We've added a new product portfolio. We've added, apart from air conditioners offering, we have now added doors and gangways, and we've added pantry systems. Plus, we have done joint venture with Eugene of South Korea for gear couplers and pantographs. But all this is basically now getting built. The factories are under construction. The new factories will be up and running by next year. And we expect from Q4 FY26 onwards, we see a J curve in railway division. So there's a bit slowdown on the Vande Bharat order book because of the changes in the formation of the coaches. And there's a delay in one of the metro projects also. But nothing, changes on the outlook of Amber Enterprises Railway Division. So we are very bullish. We have guided. I would like to reiterate my guidance. We will be able to double the revenues in next 3 years. And we see a very positive growth of railways coming in. And we are also endeavoring our offering in the export markets in the Europe and US market, which will be also reflected in coming years to come.
You know, Mr. Singh, I want to talk about how fantastic it's been, right? And of course, it's so good to hear that you're giving us such an optimistic guidance. And also on the margin front, right? You've maintained that you're expecting margins to only improve from current levels. Where is that going to come from? Is it going to be on better portfolio mix? Is it going to be operational efficiency? Is it going to be the fact that exports will increase and that may contribute to your margins? And also in the EMS segment, you've specifically said that margins there too will double by FY30. You want to tell me and give me a color, throw some color, give me a sense of timeline, and of course where blended margins could stand by say FY26?
I'll speak to you about the three divisions on the margin front. In consumer durable, we've added more components, which has increased our margins, and we are adding some new product categories, which is a better margin product category. On electronics, when we acquired LG Electronics, when we started actually electronic vertical in 2018, this was a small 300 crore business with about 2.8% EBITDA margins. And we are seeing, we've already, touched 7.75% now, and we are expecting further improvement in the margins because of the reason that we have added applications. We started our applications from consumer durable, then we added hearable wearable, and then we added telecom and smart meters, and now we've added auto customers, and now we have just got the first orders from the defense electronics as our first order. And on the backward integration side, we added PCB, which is a better margin business for us, SN Circuits. And recently we have done a JV with Korea Circuits, which will also expand our margin because that is a very technologies heavy HDI boards, which we are going to bring in India. It is complete import substitution. And on the railway application, we are already maintaining 22% of EBITDA. So all blended basis is giving us this growth on the margin side.
So do you have two Korean JVs? The Korean Circuit and Amber Group have announced the JV this quarter. Is there something else as well on the railway side? Sorry.
Yeah. So one is Korea Circuit, which has been signed recently in the electronics division, where we are bringing up high density PCB boards and semiconductor substrates and flex PCBs. We already were doing single layer, double layer, and multi-layer PCBs in SN Circuit. So we will become a single company in India which will offer the full stack of PCB applications. And secondly, on the railway front, we have done a joint venture with Yujin Korea for the gear, coupler, and pantographs. This is adding the bill of material offerings in the one passenger car. So we were earlier offering only the air conditioners in the railway applications. By adding, we did a TOT last year, technology transfer with the Ultimate Group of Austria for doors and gangways. We developed pantry system on our own, and we have done this JV with Yujin Korea. So earlier we were offering just 3 to 4% of a passenger car business. Now we will be able to offer 15% of the passenger car business. So we have increased the total addressable market by 4 to 5 times within the existing customers.
Sir, I want to understand from you a little bit more about the PCB manufacturing business as well. You've added a new plant in Hosur. Where is capacity utilization there at? When is it going to, and when do you see it at full scale operations? And also in one of your commentaries, you indicated that you stand to gain from the government policies related to PCBs. So what is the growth trajectory on PCB specifically, and where do you see that contribution reaching to your top line?
Well, in PCB, we are very bullish on this sector because if I take you through 7 years journey, what India has witnessed, 7 years back, India was consuming $32 billion of electronics. Last year, India ended up consuming $115 billion of electronics. And this is, as business as usual, is going to about $300 billion by FY 2030. And on a PCB side, 3.5 to 4% is a thumb rule on the electronics getting consumed. So today, India consumes about 32,000 crore worth of PCBs, but unfortunately, only 3,000 crore worth of PCBs are getting manufactured in India. And looking into this, I think Government of India gave the anti-dumping duty notification recently up till 6 layers. And that's the reason why we want to expand the portfolio in India. This is an import substitution. It's a domestic story completely. We are not banking on orders from outside. It is a good leeway. And the Hosur plant of PCB in the Ascent circuit, we are bringing up new capacities for multi-layer, single layer, and double layer. On the incentive side, it has been supported by Ministry of Electronics IT spec scheme, which is funding about 25% of capital subsidy on the plant and machinery. And we have also been able to receive good incentives from Tamil Nadu government for the PCBs, as this is identified as the sunrise sector by them. So in all, overall, there's an incentive scheme of almost about 50% for the PCBs. That's why we are getting very aggressive, and we want to be a company which completely import substitutes this PCBs for India. And we are very bullish for the PCB sector moving ahead.
Okay. So, Mr. Singh, I heard you mention that you are reasonably confident of doubling your revenues from FY24 revenues by FY27, if I'm not wrong. Is that what you said? And will this happen at consistent or better operational metrics and return ratios, or could there be, over that 3-year period, a bit of a dip as you move to execute and garner top line?
Our guidance of doubling the revenue is for the railway division by FY27.
Okay.
That is what we are looking forward.
Okay.
Our guidance for the consumer durable division is that this year we expect to outnumber the industry percentage growth. We expect that industry will grow by about 25 to 30%, and Amber will outnumber that number in consumer durable. In electronics, we have guided that we will be growing by 45%, and I think I can revise my guidance that we are looking forward for at least 50% plus growth in the electronic sector this year.
Sir, just one quick question. You have talked about very aggressive expansion plans, upward of 5 billion rupees over the next couple of years. And like you've indicated, you're adding capacity, and that's the way you're going to grow, right? You've also talked about reducing debt and improving your debt to equity ratio. Should we be expecting fundraising plans from your quarters? Because if you're going to try and do both those things, you're going to need some equity coming in.
Right now, we have guided for the capex of about 375 crore this year. We are not going to raise any money for that. But yes, since we have announced Korea Circuit JV, we are waiting for Ministry of IT to roll out the incentive schemes. Post that, we will come out with the capex numbers. And if we want to be bold and brave in launching the PCB sector completely for the electronic division, and looking into that, in case we need, then we'll be raising funds. But otherwise, as of now, there is no plans for raising funds.
Okay. Mr. Singh, any other highlight as per what you've done in the first half that we should take note of? We've gotten a great sense from you about the business. Anything else that you would like to highlight before we wrap up?
I think Amber has transformed into a very unique B2B company. We started as a room air conditioner play when we got listed in 2018. Today we have, apart from room air conditioners, we are into components of room air conditioners, non-room air conditioner components. We've added washing machines to our portfolio, commercial air conditioners. Then we built up this whole electronic vertical, which has been built up very beautifully, and very strong vertical which has been built, which is Amber 2.0 story. And in railway, we started in 2019 with just supplying air conditioners for Indian Railways. Then we graduated into metro space. Now we have added bus air conditioning system, some defense applications on the air conditioning side. And now we are going for deep into the penetration of the passenger car bill of material. So all this put together, all the three divisions are looking very positive. I think we have increased the total addressable market into multi-billion-dollar opportunities for each divisions. So we are very optimistic for next 5 to 10 year story. I think it's a complete India domestic story, and of course exports will be all bonus points. from here on.
Mr. Singh, great having you. Thanks so much for taking the time out and being with us. Really appreciate your time. Congratulations on a strong quarter.
Thank you very much for having me on the show. Thank you.
Was
Have
ours.
a good day.
That's Amber Enterprises. Very strong showing. Not so much for KPIT though, and let's keep up with that conversation. Margins came off a little bit, but the guidance is a problem. Sachin Tikekar, who is the president and joint managing director of KPIT, spoke to us about the quarter gone by and the outlook ahead. The most important point about KPIT is that they have said that quarter 3 and quarter 4, the performance may be slightly subpar. The question only is whether that can change after FY25 is over. So that is the key point that people will be watching out for. Listen into a slice of that conversation.
I think this is a great conversation, Niraj. And we see the automotive industry had a bumper year last year. I think 2023 was a great year, and there were signs of slowdown. I think there were a whole bunch of pressures on the industry. One, the whole socio-political thing coupled by the macroeconomics playing out in some of the countries, and pressure from the Chinese car makers on the OEMs, especially the European ones. I think it was being felt. It's just that the OEMs were still producing cars and making money last year. And I think from the beginning of this year, there is a realization that things have to change. And many OEMs are trying to figure out what this change means to them, hence what kind of strategies they need to adopt in terms of, the consumer preferences, the markets that they want to target, and so forth. I think that's where we believe that, and now in the last quarter was the first quarter when there were some unpleasant surprises in terms of the OEMs announcing results that were not so favorable. And I think this quarter is going to be a mixed bag too, and it may continue for another quarter or so till the time they are able to sort of make the adjustments and make sure that they are all set from the mid to long-term perspective. So in all of this, what it means is some are taking a pause to revisit their priorities, and some are going forward. So let me just give you a color in the sense that how we read the OEM behavior in different countries. In the US, because there is a 100% import duty on the Chinese vehicles, the US OEMs are doing all right. They know they are under pressure, but you see GM announcing fantastic results yesterday, and the forward guidance is also pretty solid. Tesla is looking okay too. So the US OEMs are okay because they are sort of protected in the immediate future. So they will continue to make their investments. The most impacted are the European ones, especially the ones in France and Germany, where they are feeling the pressure. They had large chunk of their business coming from China, and they're also facing competition from China in some of their markets. So, we've heard news about Stellantis and Volkswagen Group about trying to take a step back and figure out what kind of investments they want to make and in which markets. That's what we are going through at this point in time. And there is sort of, from KPIT's perspective, sorry.
No, please continue.
So from KPIT's perspective, I think we continue to see closure of large engagements, and we continue to have meaningful conversations of some long-term engagements. It's just that given their strategic priorities, some of these decisions are being pushed back a little bit. And that kind of, we thought that it's always prudent to sort of let everybody know that this is the reality. Having said that, the conversations are good, the pipeline is great. So to us, it's just a matter of time before things start to really pick up from KPIT perspective.
Is it, Sachin, is that predictable, if you will? I'm guessing it is not, but the point I'm trying to get to is that do you reckon this quote-unquote, for lack of a better word, pain or uncertainty, could this last for a couple of quarters? Could it last for longer, or is it difficult to predict that right now?
Our guess is, Niraj, the OEMs will have to make decisions very soon. They cannot sit on some of these critical decisions. So our guess is it's matter of 1 to 2 quarters.
Okay.
I think, and we hope that in January onwards, I think there will be a lot more action and the momentum will really gather from April of 25. That's what we expect.
Right. Okay. Thank you so much. This is Rucha joining in. You mentioned in the conference call last evening, actually, that US will now be a good opportunity for you because, US OEMs have largely banned the Chinese software makers. So what kind of growth do you expect in this vertical? And do you expect the growth to be driven by this vertical in the second half, or still there's some time to go for this one to revive?
Rucha, we feel that the growth, if you look at our growth in last 2 quarters, primarily has been driven by Asia. And we think that the growth going forward would be a little more balanced. And I'll talk specifically about the US. US, we think that the growth will come from 2 areas. One is the passenger cars, because the software has been banned. Fortunately, GM and Ford for now are reporting healthy profits and growth. So we believe that the growth will come from, the OEMs who are in the US, from Pascar. We started to make investments also in the off-highway, especially in the agriculture and construction vehicle sectors a few quarters ago. And there are some meaningful conversations. And then there are a couple of fairly large players in the US. And we believe that in the midterm, those engagements will also get initiated, and that will actually help our growth in the US.
So US moderate growth is what you are expecting, and what about Europe? You call out that certain OEMs are still struggling. So will that affect the company's performance?
It will not affect the company's performance. So let me reiterate that we are sticking to our guidance, and we remain bullish for the midterm, including the next financial year. It's to us, from the European OEMs, specifically the ones from Germany, we believe there are really meaningful conversations that are going on. And we believe it's a matter of another 1 or 2 quarters before we see longer-term sort of engagement coming from the European. There are 2 parts in Europe as well. The passenger car OEMs across Germany, France, and Sweden, I think we'll see growth coming from all 3. And we have also started really good conversations with some of the truck makers there, the commercial vehicle companies. So we believe that these 2 sub-verticals will bring back, sort of more vibrant growth in Europe, both pass cars and commercial vehicles.
Okay, and which I think reflected in your comment that your investments in trucks and off-highway sub-verticals are expanding market opportunities. Okay, so Sachin, just to dispel, one of the notions this morning, and at least from my end, the last point on this growth piece, because it becomes important, that the belief is that the delays in deal ramp-ups or deal closures, what have you, will result in a softer second half, which is now evident if you do 18%, of course. But the weak exit rate impacts FY26 growth. Do you think that's a misnomer? FY26 is still out in the open for a strong year as things stand?
I would say so. Because right now it's looking pretty solid. The pipeline is looking good. The conversations are really good. And we also believe that the OEMs have to make some of these important decisions. And I think they are looking to consolidate things, and they are looking for a partner to take up, larger chunks of business. So, we remain fairly optimistic about FY26, Niraj.
Sure.
That's the view from KPIT on their numbers. Now, a word on Hindalco, which is down 6% before we go to Godrej Properties, because that's the next management coming up. Constellium SE is a stock that was down in trade yesterday. 28% off in trade yesterday because the demand commentary was very weak on EU and US auto. You heard bits of it from KPIT as well, that European automakers' demand commentary is looking slightly weak. Now, as a result of which, there is a negative read-through for Hindalco today. And look at what Hindalco has done. It's down about 6.5%. Now, a higher share of packaging for Hindalco definitely places it in a better space versus Constellium. But be that as it may, what is negative for one large company could be negative for the other as well. So that's to be borne in mind. Okay, so that's as far as Hindalco goes. Now, Godrej Properties is the next one. Remember, the company's net profit and revenue surged multifold to drive the earnings higher. Additionally, the company achieved about 51% of the annual guidance for booking value, has acquired land for residential project in Ahmedabad as well. And in part, while Q2 numbers were not necessarily the strongest, let's hear from the management about what they feel about the quarters ahead.
As you would be, because you track real estate for a while, usually real estate is a very lumpy business. Q4 historically for us always has been extremely brilliant. But over the years, the endeavor is to try and spread out the launch calendar as much evenly as we can. And I think this year what we managed to do is try and get as many launches in Q1. Q2, frankly, if you see from an industry perspective, whatever numbers I think have come till now, we're clearly leading the market. And in fact, if you see our H1 performance is 13,800 plus crores, which is used to be a full year sale just 2 years back. So I'm quite delighted on the overall performance from a sales perspective. In fact, we've gone like 90% on booking value growth and about 89% of the volume growth in H1. So yeah, in fact, last year's Q2 performance also was marginally lower than this year's Q2 performance. So yeah, from a sales perspective, very, very happy. On the other parts of the metrics, I think, as you rightly mentioned, collections have been a huge area of focus for us, and very delighted because we got a lot of OCs this quarter, which is delivery of projects. That is the time when your collections tend to jump up quite a bit. So we saw some kind of 7,000 crores of H1 performance, which is something like a 62% year-on-year performance. But on the net operating cash flow level, it's even much more stronger. It's about 2,800 plus crores, which is our best ever H1 performance. So very delighted with the very strong results.
And you reckon that, I'm guessing at least automakers have been saying that the start of the end of Pitru Paksh resulted in a lot of bookings, etc. and stuff like that. You reckon Q3 and Q4 could actually be stronger than anticipated? In fact, would you be tempted to raise the annual numbers because you already achieved half of what you had guided for?
I think, let me go one by one. I think, as you rightly mentioned, Pitru Paksh has a, Shraddh period, as we call it, has an impact on typical cycle. In fact, last year what happened was, it was just around early part of October, which means that doesn't really impact Q3 results. But this year, it was in the last 2 weeks of September. But, for us, if you are really ask me, industry-wise, it has been an impact, but ours has been quite strong from whatever launches we were planning to get into the market in this quarter. The second part of your question is how Q3 and Q4 looks like. I think very, very exciting because we have a series of big bang launches planned in most markets which we operate, including both Q3 and Q4. And yes, you're right. We've kind of met, historically our H1 as we're doing some sort of an analytics internally, we realized that about 37% is what our H1 is usually to H2. And a best ever H1 has been typically 40%. This time it's been like 50%, but to guidance. So yeah, we have a very high upside risk, but we want to maintain the same guidance.
Hi Gaurav, you've mentioned that in Q3 and Q4 you're expecting a lot of big launches. Now considering that, is this the reason that the 6,000 crore fundraise is on cards? Explain to us how do you plan to utilize these funds for?
Sure, Rishi. I think the capital raise that we are looking has got nothing to do with our performance on the sales side. In fact, we have enough and more to sustain a reasonable growth. But I think what we're going through is explosive growth. If you see, Godrej Properties grew about 56% between FY23 and 24, and 22 and 23, and FY23 and 24 grew by 84%. In H1, we've grown by like 90%. This is, by any standards, one of the most explosive growths we've seen. And to fuel and maintain the pipeline, because we are seeing launches and performance far higher than what we had both underwritten and expected. So to maintain, and the market opportunity is, we want to look at this purely as a growth capital and take the trajectory to its continued great orbit that we managed to do that. But frankly, if you ask me, for the next 12 to 18 months, we have enough and more to deliver on great growth.
And considering that, you've mentioned that this is for the growth opportunities that you're seeing these fundraisers, what is the kind of, I want to understand on the pricing trend. Now, with the new launches, there has been a high velocity of new launches that we've seen across real estate sector. But given that the high pricing demand that we are, overall growth that we are looking at, do you expect the pricing levels to stabilize from here onwards? And how would that lead to an impact on the launches if we see?
I think if you see generally, pricing has been a sort of a secular trend across the last, say, 24 odd months across India. But the degree of price appreciation has been varied, right? I mean, north markets like NCR and Gurgaon in particular has seen a sharper price increase, followed by Bangalore, then by Noida. And Mumbai very recently has started seeing a reasonable jump in pricing. And relative to that, Pune is yet to even take off from relative pricing point of view. So I think different markets are a different cycle. So I would say, that next 12 months to 24 months, there should be good opportunities of pricing growth in specific markets. And I also feel the markets will change. Like Gurgaon will move from periphery markets to Golf Course Road, which is where our dominant new exciting set of projects will come. So from what we've underwritten to launch, I'm reasonably confident we'll deliver better pricing growth. But, how much it is, to what many quarters it will continue, very difficult to frankly crystal gaze. But in the very near term, I think there is some reasonable probability that in many markets we could see reasonable price growth. But yes, different micro markets are different. So like I was mentioning, Gurgaon, I think Golf Course Road is going to see the massive action from all of these KPIs. But, if different market is going to see different pricing trends.
All right, that's Godrej Properties, of course. And the stock solid 3% higher on what I thought was a decent quarter, of course. But the markets, just pull them up before we wrap up this edition of India Market Open. The Nifty for itself, just about lying flat. Broader markets too had a flattish start, but picked up from yesterday. I mean, yesterday about 1% higher for the small cap space. Today started off marginally in the green, but currently absolutely flat, at least for the mid caps. Individual stocks flying around, of course. We'll take a break, or in fact wrap it up on India Markets Open. Up next on Talking Point, we speak to Nissan Joseph of Metro Brands, and then do a conversation on the capex possibilities with Vinod Karki of ICICI Securities. Stay tuned. Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. The first piece on Talking Point today is a conversation with Metro Brands. The retailer posted Q2 numbers while profit and revenues saw a mid-single-digit hike. Margins contracted a wee bit. To put these numbers into perspective, more importantly, to put the demand picture in the country currently into perspective. Mr. Nissan Joseph, CEO of Metro Brands Johnson, right now on the show. Mr. Joseph, good having you. Thanks for joining in. Before I talk about the quarter per se, Mr. Joseph, would love to understand from you where or what is your view on this whole conversation that is coming up about the urban versus rural demand. Suddenly, with companies like HUL and Nestle talking about different categories, albeit, but talking about how rural demand is picking up, but urban is waning. It set the cat amongst the pigeons. I would love to know your views here, sir.
Thank you, Niraj, for having me this morning. You know, we don't look at it as urban versus rural because, you know, the recovery was different if you go back post-COVID. What you're seeing post-COVID is a lumpy recovery, right? And in a good way, too. So we had a great year, the year after COVID, and everybody had a little bit of a challenge. So when it recovers and the economy tends to normalize, well, consumption tends to normalize, it's not a straight line recovery or normalization. It tends to be a little bit lumpy. You know, what we're really happy about, though, is that the fact that two things. One is our Q2 numbers saw an improvement over our Q1 as far as, you know, year-to-year growth. That's number one. Number two, you know, we continue to maintain our profit percent, though we did not have the revenue growth, which shows that, you know, there's some strong operational and financial discipline inside our organization. Right? The other point I want to point out is that in Q2, we have Crocs does extremely well. So that's on the tailwind side, and, you know, because of the monsoons, and it did very well for us over the monsoon season. On the headwind side, you know, we had to liquidate some of our inventories in Fila and take some accruals for that inventory, that last bit of inventory that's left over, that depressed the margins a little bit. It is also a quarter where we have the end of season sale. So you don't have an upside of a lot of full price sales happening in the same quarter. So there's a couple of headwinds, tailwinds in that quarter, but overall, I'm quite pleased to see that we came out and we maintained our profitability, both in percentages and also on the EBIT took a little bit of a hit. But like I was saying, that was only because of gross margin erosion and also the fact that we started investing in marketing late in Q2, getting ready for our Q3 season.
So does that reverse the last part, Mr. Joseph? Let's stick to Metro now. Does it reverse in quarter three? Is the old inventory stock largely over? And are the marketing spends, the velocity at least, behind you now?
Yeah. So absolutely. The large part of the Fila liquidation is now behind us, right? There's still some small pieces left, but nothing of a significant nature. So that's number one, right? The marketing spends, what we did was we spent more in Q2 this year than we did last year. So now that's going to normalize. Not that we're not spending on marketing in Q3, we will, but then we had those numbers to go up against last year too. But what's really exciting though, Niraj, is when you look at all the other expenses that we had in our business, we were able to maintain control on them and hence delivered the profitability that we did.
Okay, fair call. Now, what about revenues though? I hear you that the operational metrics may improve in quarter three itself. How has the start of the season, if you will, been thus far? It's about 24 days or 22 days from the time Pitru Paksh got over, though I don't think that impacts sales for products such as yours. But how has the festive season been thus far?
Well, so, you know, this festive season is unique in the sense that both the two big drivers for Durga Puja and Dussehra and Diwali are both earlier this year, right? So what's going to happen is you're going to see a lift in October because both those seasons come in earlier and they would impact October. So we're seeing that come in very positively and good. But then also in November, where we have as a tailwind there for us is the fact that there are significantly larger wedding dates for both November and December than last year. And that's a big driver to our revenue as well. As you know, in Q1, we were challenged with it because there were absolutely zero wedding days compared to the year before. So we're seeing some good tailwinds coming up in the future. You couple that with the fact that we have deep operational rigor and financial discipline. You know, I'm confident that, you know, we would be able to deliver to the numbers that we've always guided to.
Okay. Foot Locker was supposedly a big thing and probably still is, but they have now an additional tie-up as well, I believe, with Nykaa. Is this a negative? How do you characterize this?
So first of all, I think it's very exciting that Foot Locker launched in India.
Of course.
It's a great day for all of us to start having access to global brands in a different way. They're the only multi-brand retailer we have in the country that sells premium athletic footwear. So that's very exciting. The other thing that any retail brand needs to do is to ensure that they have both a digital presence and a brick and mortar presence, right? So we coincided both of them on the same day, and Nike are great partners for us to do that with. They have a great reach, they have a great footprint in the country. So I think it's a very exciting partnership where we're able to leverage two best-in-class operators. You know, you have Metro that's an absolute best-in-class when it comes to retail brick and mortar, and you have Nike that does extremely well in the digital space. So it was a very successful combination of partnerships, a unique one, both for Foot Locker, and I don't think we've seen too much of that in India. So it's a unique one that creates actually a lot of good synergy.
Okay, interesting you talk about that the thing is us, Mr. Joseph. Good to see that. But you don't foresee that it will take away some of the sheen that might have happened if it was an exclusive partnership with you?
Listen, what we're keen about is, are we taking care of the customer as best as we can, right? It's not about sheen and shine. It's not about proprietary or not. What we want to make sure is that the consumer has a seamless experience, both, for a Metro business and for a Foot Locker business, both digitally and offline. And that's, we feel that that's been accomplished with this move.
Mm-hmm. Okay, fair call. Now, talk about your own presence, right? You are, I'm presuming, ramping up some of the e-commerce sales as well. There is also joined at the hip to that is the performance of the revenue per square foot trend for you, which if I look at it in a slightly micro fashion, over the last 3 quarters, the numbers have come off a little bit. 4,800, I believe, in Q4, FY24. The last reported number, if I'm not wrong, is 4,300.
Right, that is correct. Q2 is our lowest quarter for a lot of our metrics, right? It's just the nature of the retail business. That's number one. Number two, we've also seen our penetration into tier 3 cities go from 15% to 16%, right? Now, I know that just seems like a small number, but when you're talking about 850 odd stores, that's a significant move, right? Tier 3 cities don't come in at the same sales per square foot. So as we expand, it takes a while for those stores to mature. We don't expect our sales per square foot to tail off in any way, but we have that little bit of the launch, the rollout impact happening. And when you have a low quarter like this, it wasn't, while we recovered very well compared to Q1, it's not where we would normally post our numbers. So you're going to see some of that happening.
Last couple of questions, Mr. Joseph. How would things shape up? So 2-part question rolled into one. One, I heard you say that there are some exciting days ahead. I was speaking to some other retailers who were saying that the next 2 quarters will probably have the highest number of wedding dates, maybe until May 2025, but we'll have the highest number of wedding dates that India has seen in a particular wedding season. So does this augur well for you? Part 1 of my question is that. And part 2 is, do you complement that via heightened store additions as well? Because if I'm not wrong, you've done about 20 in quarter 2 gone by. Is that in line with what you had thought of? Is it lower? And do you expect to expand that number?
Yeah. So a couple of things one at a time. I think you're absolutely right on the wedding dates. It speaks very well for the future of our business when we have more and not only more wedding dates, but also spread over a period of time, right? And that actually goes on all the way through July, Niraj, of next year, not just through May, the propensity of wedding dates compared to the year before. We actually have wedding dates in July of this coming year, which we had 0 in the year we're in right now, right? So that's definitely what we're very confident and optimistic that it speaks well for our business. It's not about being optimistic about business. It's about understanding the consumer for us and then matching your expense lines and your investments in line with that. We did open 20 stores this quarter net. We have opened 45 stores for the half so far. We've guided to doing between 200 and 225 stores over 2 years, which would put us at the 100+ range each year. And we're confident we will achieve that in the coming quarters.
Okay. Mr. Joseph, when I look at what you've done from March 21 to March 24, right, from 800 to 2400, that's nearly a 3x jump over 3 years. The trailing 12-month numbers much better than what you did in March 24 as well. What is the medium-term outlook that you have for Metro Brands? Do you reckon? I mean, it may be a formal target which I may have missed. Then excuse me. But if there is not a formal target, then just informally, do you reckon that with the business space that you are in and the way India is growing, that doubling every 3-4 years the top line is a possibility?
I love forward-looking statements. We've guided Niraj to the fact that over a period of time, when you look at a 5-year CAGR, we will be in the 15 to 18% range. So right now, even after a couple of challenging, lumpy quarters, we've had probably four quarters of lumpy sales. We're still trending over 14%, right? We're confident that over a period of time, when you look at the long-term horizon, that's a number we're very comfortable guiding to, given the strength of the Metro brand business. Under all its different banners, given the growth of India, given the move and shift to premiumization that Metro plays really well in. So we're pretty confident about those numbers as we go forward.
Yeah, and viewers, I should apologize to Mr. Joseph in some sense, because you can't take a low base of FY21, which is impacted by COVID, and then look at the growth over 3 years and then try and extrapolate it. But 15 to 18% number, Mr. Joseph, is that what you were saying that you will probably hope to do over the next 3, 4, 5 years?
That's correct. Okay. That's absolutely correct, Niraj.
And last question, you won't need any serious equity fundraise to do your expansion plans, or is that something that might happen?
No, we're very fortunate. The way we run our business, we generate a lot of cash in our business. So it's not a question of having the capital to invest in businesses. But, Niraj, we're also strategic about how we invest, right? So last year, the year before, you saw a lot of retailers grow their stores, expand very heavily, right? All that does is spike up rental prices. So we decided to just slow down just a tad. And I believe in the last couple of quarters, we've seen other retailers do a net closure of stores, right? So those things always tend to also be lumpy as far as rentals go. And when it's on the high side, we tend to slow down a little. When it's on the low side, we're confident enough about the Indian economy. We're confident enough about our business that then we rapidly expand. So we're a little contrarian, but we're confident that growth is there.
Well, wish you all the best for that growth. Mr. Joseph, thanks so much for taking the time out and being with us today.
Thanks, Niraj.
That's Metro Brands for you. Confident about the medium term and hopeful of, or rather confident about margins improving, gross margins improving in Q3 and Q4. Vinod Karki, Senior VP Equity Research at ICICI Securities, joins in for a completely different conversation, but I'm tempted to ask Vinod a thing or two on consumption right now, because we just spoke to a few consumer companies. Vinod, great having you. Thanks for joining in. I hope all is well. Niraj here. I want to start off, I don't know if you got a chance to hear a little bit of the conversation that we were having in Metro as well. But on retail, Vinod, what's happening here? The trends are changing. There is quick commerce coming in, eating away at some of the pie for the FMCG or rather the staple retailers, if you will. But newer formats, the way Trent is coming out, they're doing wonders. Metro Brands has not done very well in the last 3-4 quarters, but confidence of 15 to 18% growth for the next 5 years. How do you look at this space?
Yeah. Hi, Niraj. Thanks. So I think this has been a hallmark for some time now, I guess, because look at a lot of categories of retail. Eating out, going to restaurants, having pizzas, burgers. I don't think as a overall consumption basket, if you were to take the overall aggregate demand for these kind of consumption categories, things would have weakened. But as you rightly said, sir, there are so many channels. For example, earlier you used to have one retail guy selling burgers. Now there are so many. You're spoiled for choices across the board. Cloud kitchens and other brands and foreign brands all coming in and chipping away. So I think that's the thing. From an aggregate consumption, discretionary consumption perspective, I don't think there are issues at the macro level. It's more to do with a lot of players getting in, new channels evolving, and the traditional channels getting chipped away in terms of their market share. So I think that is the thing. But overall, from a overall consumption perspective, things are looking a little worrisome in the sense there was this the expectation that rural consumption will pick up sharply this year. But I think what has happened for rural consumption is that the weather patterns have been pretty in a disarray, and there are further expectation that it will continue to be so. We saw rains in October, which is a peak harvest season. Basically, crops are standing, and then they get impact. There's a damage to the crops. Inflation goes up. We're seeing the vegetable prices really shoot up. And at the same time, when I look at the rural wages, they are trending at 5-ish kind of number, while CPI rural is almost 6%. So we are looking at a situation where wage growth may be lower than the inflation. So real income is an issue, So so that's an overall picture. But there is a silver lining that the monsoon overall has been good, so which means that the reservoir levels are at 87% of capacity. So if you don't have a severe winter as that is what is expected, the Rabi output might look good. So that may be a silver lining. But we'll have to watch out for these weather patterns. If they subside and we don't have a very severe winter and these unseasonal rains stop, I think we are in for some pickup later in the year, next year, basically, towards the end of the year, financial year.
Okay. The other aspect is the conversation that we are having earlier with Amber Enterprises and EMS, and that space seems to be showing some really strong growth even now. Amber had a great quarter. Dixon today expected to come out with a good quarter. A couple of the smaller ones have delivered as well. This space largely growing, at times goes through a bit of a flux in terms of valuations, but growth can't be questioned. My question to you is really, at a point of time when the market is clearly differentiating between paying top valuations to high growth companies versus punishing companies which may have been perceived to be high growth but are missing. What is your view on the EMS space?
Yeah, you have already said what I think about it. It's basically the growth outlook is not questioned. I mean, you can't question the long-term growth outlook for this sector. It will continue to grow. But the point is if the market has kind of priced in the higher growth early, so there will be a phase of some kind of a consolidation before the valuations look. You'll never get a very cheap, attractive valuations. But where the PEG ratio, when you look at these high growth companies, the only thing you can do is, let's say the company is growing at 30%, and the PE is around 40 times. So so it is like 1 point something. So that becomes a benchmark. So if you are like a 50p kind of a stock, getting 30-35% growth or 25-30% also, you are still within the range. But if the growth slumps to, let's say, closer to the GDP, which is already trending at 12%, and you are at 50-60p, then it becomes difficult. And if the expectation was 20-30% and it comes to 10-12%, so that will be the key. So earnings downgrade, growth revisions, that will be the key. But the story, in fact, remains till it is broken, I guess, for this sector.
Okay. A lot of question marks over the capex intensity, and we know that the government capex slacked in the second quarter or the first half, if you will. Elections, rainfall, what have you. Almost every number points to that. I don't know if you think about it differently. My question to you is, do you expect a pickup here? And could it revive the fortunes for the capex-linked sectors?
So we specifically pointed out this in one of our reports. We said that if you look at this anomaly of general elections, same thing happened in 2019. This government has this habit of doing front-loading of capex, because when the Feb you announce the budget, then in the Q1, that's the fastest capital outlay quarter, because then monsoon sets in and slows down, and then it starts to pick up again in Q3. But by then the opportunity slows down to really. So, but this year, like it happened in 2019, there was a YOY, because in non-election years it has been front-loaded, and in this quarter, because of elections, it fell significantly. And in FY20, when the 2019 elections happened, the capex was back-ended rather than front-ended in that year. We expect that to happen exactly like that in this year, because what can scale back the government's capex plan, which is around 11 trillion, which means almost more than 90,000 crore plus of capex run rate per month, and we are trending at around 60,000 crores. So just to make up the trend from here on might look very strong, but that is statistical. But anyways, because it was a slowdown period in the first half, people had started to think that, okay, this is slowing down. I don't think that's the case if you go by past precedents. So we expect a surprisingly, and not surprisingly, I mean statistically high number in the second half. Not only for government capex, because you know that when the elections are around, the private sector is also hesitant in terms of new capital outlay. They have a wait and watch approach. So I think second half will be a period where you might see some flare in the capex side of the economy picking up.
Okay, okay, Vinod, let me try and understand. There is the last 1 month. We've seen the first whiff of a real corrective move, if you will, in quite some time now, at least at the broader end of the spectrum. Portfolios have hurt, are hurting, if you will. Is this a dip that you would have been waiting for? Would you deploy gunpowder? Would you recommend deploying gunpowder here? Or would you believe there might be slightly better times to deploy that gunpowder? In that, could there be more correction? Large cap, mid cap, small cap, where have you?
Yeah, so I think from a large cap, small cap perspective, we have been saying for some time now that the broader market, small caps and all, I think the risk reward was not looking good at all, despite they are expected to have higher growth. But from a relative valuation perspective, they were not looking, what I should say, the right valuations. So some more correction in small caps would be desirable. We don't know whether that will happen or not. But if you just do a sensitivity in this, and see, post-COVID, we are in we are in a bull market. The Nifty is almost, I think, 3 times and above. The only major correction we had was in 2022, when the Nifty slid by around 15%. So just doing a sensitivity of the amount of fundamental factors and how much the market corrects, you can assume that the 15% was in light of an environment where there was a nuclear brinkmanship, Russia attacking Ukraine and that kind of a thing. And then it was exactly the period where the Fed, from almost near zero, interest rates went way above 3-4%. And there was a commodity spike. I mean, oil went above 100. And across the board, commodities prices went up. We also saw very good profit growth from commodity companies that year. So I think if you look at just the sensitivity, the current scenario doesn't look to be that spectacular. Neither we are having a geopolitical crisis of that order magnitude. Neither we are having the vulnerability on the external sector where the crude goes beyond 100, commodity prices spike and we have an issue. So I think from that perspective, we have corrected, I think, 5, 6, 7% odd on the index level across large, mid, small. More correction can be warranted from small cap just because their relative valuations are unattractive. But from a large cap perspective, just going by the sensitivity in the kind of period where we are, where the large selling by FIIs get absorbed by DIIs, I think 15% was kind of peak correction that we saw in this environment. So I would assume the correction should be lower than that, given the magnitude of the fundamental impacts that we are seeing.
Got it. Okay. Okay, well, afraid we are out of time completely on this show, but Vinod Karki, take a moment to thank you for joining in today, and to you and yours, festive greetings. Have a great Diwali.
You too, Niraj. Have a great Diwali. Have a great year.
Thank you so much. Thank you so much. And well, on that note, just very quickly, just keep in mind that a lot of spaces have turned off, and come into the red, and FMCG is getting beaten. I think just as we mark that before we wrap up, HUL, Nestle, maybe some of the others should come up on your screen, 2% lower for Nifty FMCG. And just look at the kind of cuts that have happened into that bucket. So HUL is down. Can we pull up the intraday of HUL, Varun Beverages and Nestle, please, before we wrap up? HUL is down 6%. This must be the strongest fall in a really long time. Varun Beverages 3.5%. Nestle down a couple of percentage points. FMCG is taking a stick in the session today. Time up on this edition of Talking Point. Thanks so much for tuning in.